The Fed wants to tame inflation. The labor market says, LOL, that's real cute. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. about 2 hours ago until the bell rings, and it's not too pretty. The S&P 500 off by 1.5%. Big tech faring even worse. You take a look at the NASDAQ 100 down 1.9%, almost 2%. Of course, it makes sense that that's happening as you see bonds continue to sell off. I called it biblical earlier in the week, biblical again today when you take a look at what's going on in the 10-year Treasury yield, currently up almost 11 basis points, 4.7879%. Again, 15-year highs, 5% coming closer and closer. And I wanted to take a look at the yen here. Dollar yen got above 150 briefly. The yen surged. We're back down to 149. Whether or not this is intervention or not from the Bank of Japan, there's a lot of speculation, Romaine, right now.
A lot of negative catalysts in this market today. Jay Powell and the Fed, of course, watching for any progress out there on the labor market. And for right now, the balance still tilts in favor of the worker and in favor of wage inflation. The latest job openings and labor turnover survey jolts. It's out, and it's a doozy. The number of available positions in the U.S. increasing at 9.61 million, up from 8.92 back in July. That topped all estimates in a Bloomberg survey of economists. The pickup in the JOLTS data included a more than 500,000 increase in professional and business services, as well as job postings in finance and insurance and non-durable goods manufacturing. Now, sure, survey data isn't always the most reliable, but the market reaction to the strong data, it was decisive today. A downtick in equity prices, an uptick in Treasury yields, and a strong FX correlation that boosted the dollar. Katie, you were just talking about it, but most of the market volatility we've seen today actually came in the 10 a.m. hour Wall Street time, and it was in the FX space. Japan's currency reaching 150.16 per dollar, the cheapest it's been going back to October of last year. But the weakness was jarringly reversed in just a matter of minutes. The yen flipping from session low weakness at 10:06 a.m. to session high strength by 10:10 a.m. I think that's 4 minutes, soaring to almost 2% to 147.43 per dollar. Speculation that the Bank of Japan did, in fact, intervene. Now, we should point out none of our reporting has yet to confirm this. But remember, the first intervention by Japan last year came when the yen slumped down to 145.90 back in September. Japan ultimately has spent around $65 billion US dollars in total to support the yen on 3 occasions in September to October. All right, now the one thing that didn't move much today are credit spreads, Katie. Credit spreads have remained a little bit muted, despite the big jump that we've seen, of course, in bankruptcies, in consumer delinquencies, and in bank loans itself. So why the discrepancy? Some people point, well, to private credit.
Well, you think about private credit, it's really taken up all the oxygen in the room. But a really interesting report out from Bank of America, basically saying that if you look at the private credit market right now, an estimated 1/3 of those deals are going to come due in the next 2.5 years. You add it all together, they expect private debt defaults to reach 5% by early 2024. For context, their expected defaults in the syndicated loan market to be about 3% in that time frame. And just for a little bit more context, their data shows that the default rate was about 1.6% in the second quarter of this year. So a big uptick expected in private credit defaults. That's the private market. You take a look at the public market, the public debt market. Again, you're not seeing that stress. You take a look at some of the junk debt spreads right now. We're hanging out near levels that we've been for a long time. And if you take a look at past recessions, Romaine, obviously we tend to blow out in those periods. Of course, whether or not we're heading into a recession is anyone's guess. It's a hot debate right now, but taking a look at spreads doesn't look like the corporate credit market is priced for that.
All right, well, let's get some insights out of our first guest. We want to go out to Greenwich, Connecticut, where the Greenwich Economic Forum is taking place. Ken Candee sitting down with us right now. He's president and CEO of Churchill Asset Management, joining us live. Ken, great to see you here virtually. I hope you're having a good time up there in Greenwich today.
Good to see you, Romaine, and good to be with you. And hopefully can deliver some good news. Understand it's been a bit of a challenging day today.
It's been a bit of a challenging day, and as I'm sure you know, Ken, everybody is sort of focused on macro conditions, the economic cycles. But I want to start off here with what's going on kind of in your wheelhouse, in the sort of private capital space here, and the idea that you had a certain pocket of this market that seemed to be doing well, at least in terms of attracting new money from investors, if not necessarily on the returns themselves. How have things held up over the course of this year, given what we know now?
Sure. Well, the story, on the private credit side, certainly to date has been quite good. If you look at our portfolio today, we have a roughly $20 billion portfolio of private credit investments in the U.S. That portfolio continues to perform, quite well, by any metric, including, watch list, leverage points, et cetera. So certainly, private credit managers who have, a history of investing in a more conservative way, in a more defensive industries, market-leading businesses have fared quite well. Now, obviously, the jury's out here on some of the data you see coming in, but I would say overall, we've been, quite busy, despite the fact that the market overall is certainly down year over year. But we're optimistic that, if rates begin to show some subsiding in terms of increases, that stability will bring about an increase in overall activity.
I am curious, as you sort of try to talk to your existing clients as well as woo new clients here, what is the advantage that you try to get across to some of those potential clients as to why you would go, I guess, with a Churchill versus maybe either a competitor or even one of the more traditional finance institutions?
Sure. Well, look, I think there are a number of things. One is obviously the size and scale of our business today. We have continue to be one of the most active direct lenders in the market. So I think scale is very important, because if you think about companies that are looking for $500 million or more of financing, there are literally only a small number of firms that can really deliver that scale in terms of investment solutions. So I think size is an important distinguishing characteristic. And I would say the other is simply a fundamentally overall more conservative approach, focusing on industries, market-leading businesses, et cetera, that we highlight, obviously, in our conversations with investors. Today, we have over 600 institutional investors globally that are looking for access to the U.S. market, but are looking for that access with managers that have a proven track record and a proven history. So, we've continued to raise capital. I would say the largest scale direct lenders have done the same. And, we have a tremendous amount of dry powder and are there to provide, financing in a market environment where, as you know, that the large liquid markets have been largely closed to new investors.
Well, Ken, that's what I'm wondering. If you take a look at public markets right now, you take a look at both investment grade, high yield, you look at the loan space, you can get pretty reasonable returns, double digit in some cases. So when you're talking to investors, I mean, what's the pitch for an investor to go into the private credit world versus just staying in public markets right now?
Sure. Well, I mean, if you think about, our model, which is a buy and hold investment profile, if you're looking for access to high quality companies, new issuers in the debt markets, the private market is really the only game in town, or certainly has been for the last year. The opportunities in the syndicated loan market and the liquid loan market are primarily centered on trading and relative value, and there certainly are opportunities there. But if you're looking to invest in newly created, new financings, new opportunities that reflect the current realities in terms of overall spreads are certainly wider today by 200 basis points from where they were, just a year and a half ago. Lower leverage, better covenant protections, overall higher equity contributions, and frankly, overall larger companies. That's something that the direct lending market, the private credit market, is going to be able to deliver. The reality today is that the liquid market, in terms of new issue, has been very quiet. And so most of the return that you're describing has really been gained through trading and secondary activity, which again is an opportunity, but a very different one than if you're trying to get access to new deals, new companies, and new opportunities to provide fresh capital to healthy businesses that are performing well through the current environment.
And Ken, when it comes to those lending opportunities, who is Churchill and the private credit lenders in general taking market share from? Is that from the banks? Is it from private equity? Is it from everyone?
I would say it's largely from the banks. I mean, if you look at historically, the trend among the large commercial banks has been to exit many of the traditional, lending businesses, and that certainly has been, the trend for many years. I would say more recently, it's really been a lack of activity by the large banks in the syndicated loan market, right? So historically, once a company got much above 150 million in cash flow, they would then move to issue in the broadly syndicated loan market, the liquid loan markets. That has largely not been the case over the last year and a half. And so as a result, direct lenders are taking share relative to the broadly syndicated loan market. In fact, last quarter, the ratio of direct lending deals to liquid broadly syndicated transactions reached an all-time high of 11.5 times. So 11 times the number of direct deals, private credit deals versus syndicated loans. And that's a record number. So taking share relative to the banks, who have largely shied away from underwriting new transactions. And obviously, we have a lot of liquidity and we're putting it to work.
I'm curious about the quality of what's out there, Ken, or at least the quality of what some firms are grabbing. As I'm sure you know, there have been a few banks, including Bank of America, as well as Moody's, that have raised some concerns here that some of the private equity and private credit names out there are taking on a level of risk that a traditional bank might not take. And I know that in and of itself, that might not necessarily be a bold statement. But there is concern here that if too many people are sort of going down the ladder in order to find that return here, does it create the potential for greater risk?
Well, I think that, I think the answer to that is no. And I will tell you, I think a lot of it stems from the fundamental difference in the way that we underwrite and invest, right? A large cap bank, syndicated loan underwriter, is really underwriting to distribute the loan, right? So they're selling the loan to buyers in the liquid credit markets. In our case, we're underwriting to hold the loan, to own the loan, and we expect to hold that loan to maturity. So I would say that the discipline in the private credit market, given the fact that we're accountable to large institutional investors and individual investors as well, that accountability to institutional investors and of obviously the importance of our track record and our returns fundamentally takes precedence, right? So when we do a deal, when we make an investment, we make a loan, we're looking at the covenants, we're looking at the leverage, we're looking at the underlying fundamentals of the business and the company dynamics in order to make that fundamental credit decision. And so we're a buy and hold investor. I like to say that we're in the storage business, if you will, and that in the liquid loan market, you're really in the moving business, right? So in that sense, we own it, we own the risk, and therefore we need to think about the long-term dynamics around that risk. And I think that's a fundamental difference in how the two markets really operate.
There's been a lot of discussion, too, about how new deals are, I guess, sort of structured, or in some cases, old deals restructured here. When we talk about sort of the different tiers and how these investments are set up, Ken, what's different now in the way that you would structure a deal versus, say, I don't know, a couple of years ago?
Sure. Well, first of all, obviously, the rates are much higher. So today, an average direct lending deal done by us or another private credit lender, typically around 12% overall yield, floating rate. Spreads are wider, so base rates are up about 400 or so basis points. Spreads are up between 100 and 200 basis points. So obviously, much higher rates. As a result, companies can't handle as much leverage, right? So 2 years ago, a typical deal might be leveraged 6 times, 5.5, maybe even 6.5 times leverage. Today, that same deal, 4 to 4.5 times leverage. So much lower leverage, typically better covenant protections as well, better structure. I'd say the dynamics today largely favor the lender versus the borrower. Typically, if we're talking about a high quality company, the amount of equity that would be contributed by the private equity firm that's acquiring the business would be higher. In fact, if you look at our business today, the average equity contribution for our transactions last quarter was 65% equity. So better pricing, lower leverage, better covenant protections, somewhat larger companies for the reasons I described earlier, and then ultimately, a dynamic where there's significantly more equity being contributed. So, I like to say that we're in a bit of the golden age of private credit, and I still think we are. And I think that, direct lenders have a tremendous advantage right now, given the speed and certainty that we can deliver. And I think we filled a gap, frankly, in the marketplace that if you look back at the GFC, direct lending was not as prominent then, and there really wasn't an alternative to the liquid markets. And I think today there is an alternative, and we've been, very, very active in providing capital to companies as they continue to grow through a more challenging time.
Ken, it's always great to talk to you. Ken Candee there, he's the president and CEO of Churchill Asset Management out there at the Greenwich Economic Forum, helping us to kick you off to the close here on this Tuesday afternoon. Coming up here, an exclusive interview from that forum with Bridgewater Associates founder Ray Dalio, his insights on where U.S. relations with China are hit.
Plus, the business of the NBA. We're going to speak about it with Wyc Grousbeck. He is the lead owner and governor of the Boston Celtics.
And jury selection begins in the trial of FTX founder Sam Bankman-Fried. He's accused of siphoning off billions of dollars of customer funds. He says he's not guilty. We're going to have a live report from that courthouse. All that and more coming up in just a bit. This is Bloomberg.
Well, jury selection is underway in Sam Bankman-Fried's trial on charges that he swindled billions of dollars from his crypto platform, FTX. The trial is expected to last for about 6 weeks, and of course, he's facing 7 counts involving fraud and conspiracy. Let's bring in Bloomberg's Kaylee Lines, who's on the ground in front of the U.S. District Courthouse in Lower Manhattan. And Kaylee, give us a little bit more detail here on the key charges that Sam Bankman-Fried is up against.
Well, the charges are quite serious, Katie. As you said, there are 7 in total, including multiple counts of fraud and money laundering. And if convicted, they carry very severe penalties, maximum penalties of 20 years for 5 of these different counts. So if he is indeed found guilty on all of these charges, he could very well spend the rest of his life in prison. We could be looking at a sentencing here of over 100 years. That said, we do have to get through this trial first. Jury selection is today. They just brought in a new group of jurors into the room to be vetted. This process likely will take the rest of the day today, potentially a little bit into tomorrow morning as well. And then it will be when the arguments start, when the prosecution is going to make its case, which is that Sam Bankman-Fried committed one of the largest financial frauds in U.S. history, according to their allegations, that he misappropriated funds, commingled funds when he wasn't supposed to, between FTX and Alameda Research, the hedge fund that he had also founded, though had said was separate from FTX. And of course, Sam Bankman-Fried in defense is likely to say that he had, or his lawyers will on his behalf, that he had no intention of committing fraud. This is something he has maintained consistently leading up to this trial. And of course, he has pleaded not guilty to all of these charges.
Let's talk about here, Kaylee, as to what we know with regards to who we think could potentially take the stand as witnesses against Sam Bankman-Fried. Of course, a man who is in custody right now, primarily because of allegations that he attempted witness tampering.
Yeah, that's right. That's why he was taken out of house arrest at his parents' house in California and put into the Metropolitan Detention Center in Brooklyn back in August. Romaine, as for who these really key witnesses for the prosecution are, they are 3 of the people who were his closest associates at the time all of this went down. One being Gary Wang, who co-founded FTX with him, Nishad Singh, who was the head of FTX's engineering department, and then Caroline Ellison, who was the CEO of Alameda Research, that aforementioned hedge fund, and also is his former ex-girlfriend. She still is the ex-girlfriend. And guys, they already have pleaded guilty to criminal charges. They are in cooperation agreements with the prosecution. So they will really be able to shed light on this trial exactly as to what Sam Bankman-Fried knew and when he knew it, how really all of this went down. I was speaking with a white-collar attorney on Bloomberg Crypto in the last hour, and he said that they are kind of the key for the prosecution here.
All right, Bloomberg's Kaylee Lines, thank you so much. Now, coming up, the $7 trillion ETF market, it's booming, defying those saturation concerns. We're going to break down what's fueling that growth coming up next. This is The Close on Bloomberg. market is booming with 69 new funds coming to market just last month. That is the busiest month since at least 2016. Now, the newcomers include everything from passive to active to bonds to commodities, and the rapid expansion is now raising saturation warnings in the $7 trillion industry. And Romaine,
yeah,
that warning has been around since 2020, and we've added something close to 1,000 new funds just in the past 3 years.
Well, you cover this sector a lot, and I'm always curious when I hear that many funds, because when I think ETFs, I think, okay, I understand an SPY or a QQQ or even some of the more esoteric ones that try to do, double leverage that or whatever.
Right.
But by my count, that gets you to like 25 funds. So how do we get to 3,000? In all seriousness, I mean, I know there's a lot of themes that come up and everybody wants to have these separate things, but how different are these funds really?
Well, if you think about this big boom that we've seen in actively managed products, the managers of those funds would tell you they're all extremely different. And it is interesting. If you look at where the flows are headed this year, we're seeing active take a record share. But in terms of how much active assets there actually are, it's just a fraction. So if you look at that and then you take a look at bond ETFs, we're still looking at only $1.5 trillion in AUM. I'm saying only because the market overall is $7 trillion. So a lot of people that I talk to argue there's a lot of white sky still left.
Well, let's talk a little bit about the bond ETFs, because sort of the bugaboo there, why we haven't maybe seen more expansion of that, it's a lot harder to do that in an ETF wrapper than it is something like equities that is highly liquid and that you can easily sort of revalue at the end of every day.
And that's something that skeptics point to, the fact that there are so many different CUSIPs out there, whereas there's only ever one equity unless you have share classes. And that leads to a lot of these doom loop sort of warnings about liquidity, given that the ETFs that hold the bonds are much more liquid than the bonds that they actually hold. But I mean, the wrapper's been tested time and again, most recently in 2020 when the bond market all but froze, and it's recovered.
What are the costs looking like on this? Because the whole sort of selling point for a lot of these ETFs, at least in the early stages, was it was an incredibly low-cost way to get, if not active management, at least some degree of management of these.
It is a race to the bottom. Just a fun fact, Schwab's entire bond ETF lineup, they all cost 3 basis points as of last week. Those cuts just came in, so there you go. Yeah, but if you're interested, you can catch more of me and ETF analysis in general every Monday on Bloomberg ETF IQ at 1 p.m. in New York. But much more of the close coming up. Don't go anywhere. This is Bloomberg.
This is the countdown to the close, looking at a real sell-off here in the equity markets. Right now, most of the major indices hitting session lows, session highs in the yield space. Let's check in on what's going on with commodities right now with Abigail Doolittle and our commodities close. Abigail.
So it's a little bit calmer for commodities overall, Romaine. We have the Bloomberg Commodity Index down about 0.25%. This is the Bloomberg Dollar Index, is up about 0.3%. You would think that the selling would be greater, but there is some strength for the energy complex. WTI crude up about 0.5%. Natural gas really outperforming, up 3.7% on the cooler weather forecast for next week. Soybeans down just a little bit as crop have been planted for both the U.S. and Brazil. Folks are thinking it's going to be a pretty ample supply, nonetheless off the lows. Palladium and some of the other metals, though, down sharply. This having to do, of course, with that dollar strength, which pushes some of these metals, especially the precious metals, lower. As for oil, let's take a look at the ride on the year, because it's been pretty volatile. So up until June, it was sort of back and forth in a bit of a range. And then we have this big rally higher, despite the fact that the dollar is also higher, net up about 15%, Romaine, and a lot of folks are really saying that this has a lot to do with OPEC Plus standing pat with those production cuts. Yeah, certainly a tight physical market here. We want to stick in the oil space right now with the deeper look at the macroeconomic factors that have been weighing on crude prices. Julia Fanzera is joining us right now, oil futures reporter here at Bloomberg. And let's start off with the supply side story, because that appears to be the big driver, at least over the last few weeks and months.
Absolutely. As Abigail mentioned, the OPEC staying pat and not necessarily increasing their output has been very important for prices. But also, Russia recently banned all diesel exports temporarily. And that's because they've had very high rising domestic prices. But I think that was a step too far for markets, and that's why we rallied even more so. So it is really a supply story at the moment.
And how is the supply story interacting with the demand side? Because you look at some of the commentary, a lot of people pointing to the fact that this higher for longer messaging is really starting to sink in the oil market. But how is that squaring up against that still dominant supply story?
Absolutely. I think the difficulty here is the last 2 days, oil has sold off with macro markets. And analysts are saying this was a little bit too much of a sell-off. But they think that fair value oil is at the fair value right now because demand isn't that high. And sure, that higher interest rates could cloud outlook in the future, but they still see oil ranging around this price for even the next quarter next year.
Well, there's been some calls here, and we were talking about this yesterday, the idea that Ed Morris over at Citi talking about the potential for a collapse in prices back down into the 70s. Based on the idea here that he thinks that supply could actually start to loosen up a little bit more in 2024. Are you hearing other calls like that from the people you're speaking to?
Yeah, I think that Ed has been mentioning the fragile 5 nations for a very long time, and we just haven't seen the output that he expects these nations over the past couple months. And so I think that seeing the fact that OPEC Plus has not increased production and we aren't seeing yet all of those barrels from Iran and Venezuela come into the market and satiate the market the way that demand is asking, I think that prices will still remain in this range from what analysts and traders have been telling me.
Can you talk a little bit more about the range? Of course, after this months-long rally that we've seen, what is the range right now? How well defined is it?
People are saying that for WTI, it's very unlikely that prices will continue to go higher than $90 a barrel. We're seeing that as a resistance at the moment. But I would say that I'm hearing $80 to $90 till the end of the year, but then really $75 to $90 as we head into next year. But those are still very elevated prices.
All right, Julia Fanzaris with Bloomberg here, a closer look at what's been going on in the oil market. We want to go down to Washington, D.C. right now, where the House of Representatives has begun a vote on tabling a motion to remove the Speaker of the House, Kevin McCarthy. Now, this is a very unusual procedural vote that is taking place right now. It's only been meaningfully used once in the last 100 years or so. Now, we should point out this vote would not remove him from office, but if this vote fails, he would effectively have about 2 days to come up with some solution to hold on to his speakership. We'll have full coverage of this throughout the day and keep an eye on it for you. This is Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off here with Delta Airlines. Price target getting cut to 40 from 50. The analyst saying that while he doesn't expect any surprises when Delta reports earnings next week, he does foresee higher costs pressuring EPS through year end. Those shares having one of their worst days since the spring. Next up, let's take a look at Airbnb. Getting cut to sector weight. This over at KeyBank Capital. And of course, it's on the back of some interesting comments that the CEO himself made about needing to fix the platform. The analyst himself says profit margins, they've actually reached a near-term peak and says that revenue growth could decelerate to 11% next year as night bookings and average daily rate growth moderates. Those shares having their worst day since at least May. And finally, let's take a look at Warby Parker. Evercore ISI raising the eyeglass company to outperform. The analyst saying it likes the growth profile, the attractive valuation, and says developments in products and marketing makes this company, this stock, a fundamental inflection story. His words there. Those shares having a decent day, up almost 4%, and those are some of our top calls. We do want to stay in the sell side space right now and pivot to farm equipment. TD Cowen says it's cautious on some stocks in that space given concerns of a peak in the cycle and consumer health. But analyst Matt Elkott, he notes that Caterpillar could be the exception given its neutral to mildly positive stance on the stock. He joins us now to talk a little bit more about what's going on here. He rates Caterpillar and outperform. And Matt, usually when I think of Caterpillar and Deere and really all its competitors for that matter, I tend to think of economic cyclicality. And I know that Caterpillar and for that matter some of its peers have tried to find a way to break out of that cyclicality to become a much more idiosyncratic story, if not a secular story. Has Caterpillar made gains in that space?
You're absolutely right, Romaine. I think it's finally catching on. Cat's finally having some success in that message. we are cautious. The setup, I think, for machinery stocks into 3Q is not very compelling in general. I think the 3Q prints will be, broadly very strong, but investors are already expecting that, and investors are in full, cycle peak mode, so they want to hear more about 2024. But there are so many uncertainties that I think the companies are going to be even more reluctant than usual to offer enough commentary on 2024 to quell concerns. So that rationale will affect some of the still more cyclical stocks. But I think Caterpillar, there is a growing investor contingent that's finally starting to think beyond just the cycle on CAT and focus on a multi-year growth story.
I'm curious with that multi-year growth story, and I'm just going to borrow some of the jargon that you always hear with tech companies. They always talk about the total addressable market. I mean, there's only so many bulldozers and tractors and other things that you need, I would think. And I know there's a replacement cycle that gets folded into that. But I mean, how much headroom does Caterpillar have, even if they're executing very well?
Yeah, so you're right about the construction side, but the story is much more than construction. 21% of the business is mining, and that's a business that's been under pressure for the last 10 to 15 years because the pressure from shareholders of the mining companies was to do more share repurchases and essentially over a very long period of time almost buy themselves out of existence. So they've resisted really, replacing much equipment and doing capex on the actual business. That rationale is changing, Romaine. I think, I'm not saying that they're going to go investing willy-nilly now in equipment, but I think we're going to have a multi-year replacement cycle that's going to be steady, not, nothing huge to, write home about, but it's going to be a much more steadier replacement cycle over the next few years. Same with oil and gas. Data centers, which is about 10% of CAT's business, is an extremely strong secular growth area driven by power gen, actually. That's where it shows up in CAT's earnings, but it's driven by data centers, driven by AI. And then CAT has a target of doubling their services revenue to $28 billion by 2026. And they seem to be on track, if not slightly ahead, to achieve that goal. So those are some of the areas where the story stops being exclusively cyclical and has a much more secular component to it. The company that people look at when they think of CAT as a comp typically is Deere from a market cap and markets perspective.
Right.
And Deere has had its own secular story, obviously, precision ag, which is a very compelling story that's been in investors' minds for many years. We actually just did a video with Deere's chief technology officer a couple of weeks ago that explains precision ag. CAT's secular component is starting to kind of resonate with investors now.
And Matt, we only have about a minute left with you, but talk a little bit more about Deere. If you're mildly optimistic, mildly positive on Caterpillar, how do you feel about Deere right now?
I'm neutral on Deere. We're market perform on it, and I'm also neutral into the print because this is one company that but it typically gives guidance at the end of their fourth quarter, and this is their fiscal year, so it's in their regular fiscal year. So they'll be giving guidance, and there is so much uncertainty out there that even if they're feeling good about the business, I think they're going to bake in just a bit more conservatism into their guidance than usual. So I don't really see a big near-term catalyst.
All right, Matt, great to catch up with you. Matt Elkott there over at TD Cowen, a closer look at Caterpillar, and of course, as Deere as well. And we're going to have to wait a few weeks, Katie, until we get those results. I think Caterpillar is right at around the end of this month, end of October here. But it gets to this idea, too, of how those companies break out of that cyclical cycle. And we know Deere has actually made a lot of progress in terms of automation and AI, dare I say, sort of making those machines work, I guess, a little bit better for the farmers, which, of course, accelerates the upgrade cycle.
And you think about the farmers, the question I always wonder about with these companies that work so closely with farmers, that comes back to the weather, which is a variable by definition you can't control.
Yeah.
And you think about some of the extreme weather that we've seen across the globe this year. I would imagine that we'll hear a little bit more about that.
Well, that's going to be a huge story. I mean, we already talk about how the Corn Belt line has moved north, and how I'm sure in other parts of the world you're also seeing areas that you were able to plant something last year doesn't necessarily work this year and probably isn't going to work in the future. Huge implications coming up there. Coming up here on the big program, we're going to have some insights out of Ray Dalio. You know him, the former, the founder, I should say, of Bridgewater Associates. He sat down with our very own David Weston to give us his thoughts on U.S.-China relations and how he believes a potential Saudi-Israeli deal might have actually a positive impact on the economy. That's coming up on The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment where the host of Wall Street Week, David Weston, flew down on his private jet from Greenwich, Connecticut today just to be here for us as he is every day around this time. And you were up at the Greenwich Economic Forum. You had a chance to sit down with Ray Dalio, formerly of Bridgewater.
Yeah, it's always an interesting time to talk to Ray about his view of the world. And we talked about the whole world, including what's going on with the yield and the 10-year. But we also asked him about something he's focused on, which is like the disputes among countries right now and how they can affect global economy. So we specifically asked him about what's going on with U.S.-China relations and also the Middle East. This is part of what he said.
U.S.-China relations are in a number of areas on the brink of red lines. So, in other words, these irreconcilable differences, they're right on the brink. So if I was to take, let's say, the Taiwan issue, it's an irreconcilable issue, and so on. It's right at the line. The breaking point is if the United States said, we are in favor of the independence of Taiwan. That's the equivalent of a declaration of war. And because of our political issues that are now internally, you're going to be likely to push that because of the fact that many in Congress and so on would say, we will defend Taiwan at all cost and we will give them this, and you could even cross that line. My point is it's right at the edge. That's that. We have a chips issue. And we have a technology and sanctions issue. The reason in World War II, war with Japan, you had the cutting off of the oil and then the sanctioning them taking their payments. So you have a somewhat similar situation. Chips is like oil back then, and it's a very, very, very delicate issue. You have the geopolitical issue, which also is manifest in each of them, and so on, supporting Ukraine, and other geopolitical issues, which are also right at the edge. Neither country wants to go to war. Everybody's afraid of what that war would be like, because it would be devastating economically and politically. So you will see sort of the postponing. These issues will remain and probably intensify over the next 5 to 10 years, but they will be at that edge. So you're going to see in November, there will be in San Francisco the APAC conference, and you will see President Xi get together with President Biden. But we have a political situation and so on, that's it. In China, they are also dealing with a number of big problems. As we're dealing with our problems, they're dealing with their problems. Those problems are first the debt problem that has now been allowed to pass through into the system. Meaning you have real estate, and real estate counts for about 70% of savings. People put their money in real estate, and about 20% of their economy. And there was a bubble, and then that's passing through, and that goes down to local governments that were living on debt and also land sales for real estate purchases. And so that's a structural issue. They need to do a debt restructuring, And a debt restructuring is a very difficult thing to do. They can do it, but it's also very politically impactful because those who are, whoever's making these decisions determines whose wealth and how they divide the pie. So you have that going on. You have a move to what President Xi calls the 100-year storm on the horizon. In other words, he believes there's a 100-year storm on the horizon. That's the sort of things that we're now talking about. And with that 100-year storm on the horizon, you have a very autocratic, in other words, if you don't behave well, you'll lose your head, and so on. And that kind of environment, which, by the way, in war periods and so on, has been what most countries have moved toward or something. And so that's having an effect on the economy. We have the U.S.-China conflict itself, which is affecting what companies do. Do I want to be in China or do I want to be in Vietnam? That's one of the things that's benefiting neutral countries. So they think, okay, the ASEAN countries, India and other places can be a beneficiary of that. Where do I want to be? But that's also hurting them. And then, of course, that we have a world economy which is relatively slow moving. That affects their exports. So they're going through a very difficult period.
So let's try to end this on a high note. Middle East, of all places. Middle East. As I understand, you have an office now in Abu Dhabi.
Yeah.
There are a lot of reports about a possible deal, seems unimaginable, of Saudi Arabia, Israel, and the United States. Don't know if that's going to happen, but it looks like it might definitely be possible. If that happened, how could that transform, certainly that region, but maybe the global economy?
Well, there's a realization there that not fighting and prosperity is better than fighting depressions. So for very practical reasons, if you take MBS, MBZ in the UAE and so on, there's a desire to move in that direction, dealing with the geopolitical issues. Those geopolitical issues are to some extent within the region, having to do with Palestinian and so on, and to some extent worldwide, like in a conflict. So the movement, you saw a movement, Saudi Arabia and Iran. Whoa, that's a big deal. And now you're seeing that line up in that way with Israel. So as I say, there are three things that I'm looking for, right? Do you earn more than you spend? They do. Do you have an environment in which there's internal vitality and people working together and so on? A lot of changes have been made in these places to make that really, I mean, it's a vibrant place. These places are talent magnets. They're competing for talent and they're getting talent because of that environment. And are you in risk of one side or another of the war, or can you stay neutral? Because the neutral countries do better. So that's what they're benefiting on. Those countries are, they're doing very well. And there will be places in the world, India, ASEAN countries and so on, which will do very well while all of this is going on.
That was Bridgewater Associates founder Ray Dalio. Romaine, Katie?
All right, thanks there to David Weston. We want to go back out to Washington right now, where we are learning by a vote of 218 to 208, a procedural vote that would effectively allow the House to move forward with removing the Speaker, Kevin McCarthy. That vote has failed, so effectively this means that on a procedural basis now, the House can move forward with a more formal vote to remove the Speaker of the House. I'm told right now that the Speaker, Katie Greifeld, has about 48 hours to call a vote on the motion to vacate, which will determine whether he will remain Speaker or not here. There's a lot of procedures, and I'm sure for people who don't understand the politics here and the procedural politics here in the U.S., this is, I won't go so far to say unprecedented, but is it incredibly rare.
Incredibly rare. Let's get to Wendy Benjaminson. She's our Bloomberg senior editor joining us from Washington. So, Wendy, this largely was expected, this vote that went today. When we get to this next more formal round, how are we expecting it to go?
Well, it depends on what happens in the next 48 hours. You're both right that he has probably now about 2 days to do some serious wheeling and dealing if he wants to keep the speakership. He may at this point be throwing up his hands and seeing that he doesn't have support and decides to just let the vote happen or even step down voluntarily. Knowing Kevin McCarthy, as those of us who follow this in Washington do, that's probably unlikely. He went 15 rounds of votes just to get the speakership only 9.5 months ago, and so it's unlikely he's going to give it up quite so easily. So now he has to go to Democrats and ask for certain things and to Republicans to ask for certain things.
All right, Wendy, really appreciate that. That is Wendy Benjaminson. Thank you so much. A lot of drama in D.C., a lot of drama in these markets. You take a look at the S&P 500 right now, down by 1.4% as yields continue to spike. Full coverage coming up next. This is Bloomberg.
When would we fight? Now is and was the time. With the Democrats driving the fiscal bus.
About 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Stocks right now near session lows. Katie Greifeld, we talk about where the level of support is before this market right now, and it appears to be a little bit lower than maybe what we would have thought a couple of days ago.
Yeah, more sellers than buyers. I think it's fair to say that. And of course, it feels very much like a rates-driven equity market. You take a look at the 10-year yield up mightily today, 12 basis points. We actually kissed 480, and now we're a little bit below that level, Romaine.
Yeah, there's really just not a lot of confidence right now in a lot of risk assets, at least not at the valuations where they are right now. You see that reflected in the consumer discretionary space as a group, down almost 3% on the day. We were talking the other day about how one of the main tech indexes has now reached correction territory here. And of course, you also see that in the cyclical space. Similar story with the transports, down more than 10% off some of those recent highs. And all those highs that we saw basically kind of mid to late July here, all those gains have been erased on all of the major indices.
I mean, and you can really see that stress when you take a look at utilities. Quite a move underway in that sector. I don't have the size and scope prep for you, but I mean, the chart alone, if you pull it up, it's really been a bit of a straight line down.
Yeah, and it's sort of like because it begs the question, sort of what arrests this drop, right? We know the uptick in yields seems to have to do with some of the hawkish commentary we've gotten, although we got some dovish commentary by Bostick, though I guess he's always been dovish and he doesn't vote this year, so nobody really cares. The other Bostick, you know, number 2 Bostick in the world. But the thing is, but that's interesting about it is this seems to be have gone much further than just sort of what the Fed may or may not do here. Yeah. This seems to be a market that is looking at the gains from the first 6 months of the year. They're looking deeper into this year and into 2024, and it's hard to make a case for some of the valuations out there.
Absolutely. And again, you think about what's going on in the bond market. I feel like maybe if we weren't seeing this move in interest rates, maybe some of those valuations would be easier to stomach. But I've been basically begging for a reason why we're seeing this move in bonds, both on television and off. And it feels like just the magnitude that we've seen, we've started to go back to reasons such as supply, things like that, of that nature, maybe the Bank of Japan, et cetera, those foreign investors not buying. It really feels like we're searching for reasons here.
All right. We do want to go back to one of the big stories of the day, which could have some market implications as it unfolds over the next 48 hours or so. We're learning that the House has voted to consider removing Kevin McCarthy as Speaker. Megan Scully, who helps lead our congressional coverage, joining us right now, Megan. And the big question is right now that if we get to an actual vote that removes him over the next few days here, who would actually replace him?
That is a good question. There is no obvious successor. Steve Scalise, the number 2 Republican in the House, is currently undergoing cancer treatment for a rare form of blood cancer. And it's unclear who would be McCarthy's successor, which wing of the party this person would come from, and basically who could get the 218 votes that is needed to take this job. All
right, Megan, I'm sure we're going to check in soon with you again. I'm sure here again, looking at Kevin McCarthy and his future as we count down to the close. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld, joined right now by our colleagues Carol Massar, Simone Foxman filling in for Tim Senovic today. Welcome to our audiences across Bloomberg Television, Radio, our originals, and our partnership with YouTube. Stocks at session lows, Carol Massar. Yeah. But before we get to the markets, I think we have to go back to what's going on in Washington right now, a procedural vote today here that would effectively set up a scenario to remove the Speaker of the House on a procedural measure that hasn't been successfully invoked since 1910, a Speaker who just came to power this year.
Right.
In January.
Just came to power.
January of this year.
Yeah.
And it looks like here in October, this could potentially be the end.
Yeah, it came to power, but, you know, it wasn't like the Republicans were all in on him, right? He came and he seemed to have given away a lot in order to get that position. And having said that, here we are and the year isn't over, and that job is certainly in question. What's interesting, Katie, is that balance of power in Washington, whatever the outcome of all of this, is dramatically going to shift. And we are living in an era, whether it's the Treasury market, whether it's climate change, so many things are dramatically shifting under us, and certainly front and center is politics.
Do you think this is going to affect the markets, though? Because we always sort of talk about this idea that politics doesn't necessarily move the market, at least in the way that we talk about in the media. This is the Speaker of the House who has, at least right now, no viable successor that would be, you know, I guess, any more competent than he is here. And at a time where we haven't passed a budget, we got 45 days before we get to a new one, and we could potentially be trying to do this with a completely different speaker.
Right, so shut down. And I also think about what the world looks at in terms of we are supposed to be the government and the country where things are expected. It's not the unusual. We can count on it. And then we continue to see upheavals in our government. And that's I think about our allies and how they look at us.
Yeah, but at the same time, you know, McCarthy giving away to some degree a little bit of power when he became the speaker back, 9-10 months ago, and then maybe giving away a little bit of his leverage to the Democrats.
Well, not a little bit. He gave it away. I mean, he basically compromised and said one vote. That's all it takes. One guy to stand up and say, I want this guy gone. And, well, that's what happened. We knew this was going to happen.
But he could come back now and give that same leverage back to the Democrats. That's certainly what seems like a potential path.
The Democrats are hanging him out to dry. Hakeem Jeffries already out with a statement saying the Democrats are not going to support.
But that's politics.
We got some time, right? We got some time.
And I'm curious to see where the wrangling goes here.
The wrangling goes?
The horse trading, if you will.
The horse trading.
That kind of does happen in politics.
When's the next downgrade, Carol Massar?
When's the next round for the United States? I don't know. What I'm trying to figure out is, man, the debate that I think continues, the Fed members are so clear in higher rates for longer. We get it. And then you have State Street coming out and said, yeah, we're thinking maybe a full percentage point of cuts next year, maybe even 200 basis points. That is interesting to me.
It is interesting. And you think about what would actually prompted, and I fail to think of it other than a recession. You talk about 200 basis points of rate cuts, 100 basis points, maybe that's normalization back to neutral.
They talk about slowing in growth and inflation.
Exactly. So there you go.
Yeah, I mean, look, look, you want to go back to the markets. There's a reason why you see the NASDAQ down a couple of percentage points on the day and the S&P down 1.5% here. This isn't because good times are coming, is it?
You know, but we say higher for longer. But then when you read through some of the commentary that we've heard from Loretta Mester and Rafael Bostic today, both of them not voting members, you know, Mester was saying it's not appropriate to hold rates where they currently are until you get to 2%. But meanwhile, Bostic came out with a bit more of a let's hold them until we get back to that 2% level. Are Fed officials really as in agreement as we have seemed to think they are?
No, they're not in agreement. I mean, I know they put on a happy face every time they come out and say, oh, this was unanimous. But I think that could change dramatically when we get to the meeting at the end of this month, October 31st, November 1st here. And maybe you'll start to see a little bit more dissent here. But the fact of the matter is the pace of this economy and the direction of it is probably just as much of a conundrum to them as it is to us.
Jolts, anybody?
Jolts. Job openings, Carol Massar. There are 9 million of them out there, and only half of them are ghost jobs.
I mean, exactly. Well, that's the problem, right?
Oh, wait, I'm sorry. There's one more. Apparently, the Speaker of the House is looking to hire someone. $200,000 salary, not bad.
Oh, too soon, Romaine Bostick. All right, we're going to come back in less than, a little bit. Okay. We're going to come back in less than an hour.
I didn't know you were a big McCarthy fan.
I'm not, but I would like to see them actually govern and work on policy rather than
that's sweet.
Infighting. I know, right? I know. So sweet. All right, we're going to be back in less than an hour's time.
I love Carol. She's such an optimist.
I try. We'll see you on radio, TV, YouTube, and, of course, Bloomberg Originals. And we'll be back, 4 p.m. Wall Street time.
All right, we'll check in with Carol Massar a little bit later in this program. We'll check in on Washington a little bit later as well. But right now, let's go back to the Greenwich Economic Forum, where our next guest is standing by right now. Joseph Quinlan, Chief Market Strategist over at Bank of America's Private Bank, joining us right now to talk a little bit more about the market moves that we've been seeing here over the last few days, weeks, and months. And I am curious here about this idea as to what exactly is being priced here into the market. Are the gains that we had at the start of this year, the first 6 months or so of this year, was that pretty much it? Are we kind of now just kind of sailing the drift?
Well, Romaine, it's a great question. We are giving back those big gains that we saw in the first half, and you touched on it just a couple minutes ago. It's higher for longer. The interest rates, you've seen the 10-year just bust through 4.5, 4.75. It's worries about Washington, the budget deficit, oil prices. So it seems like everything's piling on right at the wrong moment, so to speak, for the markets. We're coming out of a difficult September. October could be better, and we're still looking for a year-end rally, but that doesn't feel much like a rally today. So there's just this piling on effect that's weighing on the market and market sentiment.
And particularly when we look at kind of the correlations with yields, at least as of late. I mean, just today, we're up 15 basis points on a 30-year, 12, 13 on a 10-year. And that negative correlation between where yields go and where stock prices go. I am curious if anything sort of arrests that. If we get some clarity out of the Fed where they finally are willing to communicate publicly that they are indeed done and that rates are either going to stay where they're at or maybe even potentially come down, do you think that would have a material impact on market sentiment and market direction?
I think it would, Romaine, but I'm not expecting that the Fed to back off on its 2% target. It's too soon. But to your point, if we get better than expected earnings, we start pretty soon, that could give the market a little bit more confidence, put a kind of a floor underneath this downdraft that we're in. So I think it's going to boil down to earnings. We know where the Fed is going to go, what they've said, a lot of talk. You were just talking about that. We've got to work through what's happening in Washington. But I think, between now and, say, the end of the month, it'll come down to earnings. And, the estimates are all over right now. But just suppose Q3 is just as good or not as bad as Q1 and Q2. That sets us up for that year-end rally. But we're not there yet.
Well, bring that higher for longer message to corporate earnings. If we actually are entering into a higher for longer sort of world, how does that affect corporate America? How does that affect balance sheets and the numbers that we get on a quarterly basis?
Well, the cost of capital, obviously, is one pain point. Higher oil prices is a tax on consumers. That could filter in the weaker consumer demand. You've got the budget deficit is out there. That weighs on the sentiment as well. So, that's going to be kind of how all this plays out. We need, we need a circuit breaker. We need a circuit breaker for this market to kind of stabilize and push forward. But we're not there just yet. But everything you talk about weighs on consumption, consumer confidence, the cost of capital for firms. We're going to financials will kick it off. There'll be a lot of interest around what are they seeing with delinquencies. So all these variables are coming to a head.
What sectors actually do well, if at all, in a higher for longer environment that you just described where the cost of capital is higher? Does that benefit on a sector basis, or is that more about the size of the company?
More sector, Katie, like for instance, we're overweight energy. We like minerals, metals, the energy complex, harder assets, inflation hedge, or at least keep up over and above the cost of prices. So that's where we're looking. We're playing more defense as well with healthcare. But we had a long debate in our investment strategy committee about moving towards cyclicals, but it's too early. We're not early cycle. We're still late cycle. But that's where we're leaning. We're leaning into cyclicals, but that call is just too soon just yet. But that's how we're thinking. But energy is where we see some value, some opportunity, and some place to kind of hide out, other than say cash or money markets.
Cash or money market. Well, I mean, can you argue with that, Joseph? I mean, it's easy to kind of, okay, cash, money markets. I know that trade isn't going to hold up forever, but when you consider that you're able to get, 4, 5, 6%, depending on where you are, with basically no risk, why wouldn't you do that?
No, Romaine, exactly. We have that conversation with our clients every day. You can't sniff or sneeze at 5% money market. But here's the thing: since 1945, compounded annual average return of the S&P 500 is around 11.2%. So really historically, you got to see the big picture. Equities are what's going to drive wealth. But here now, to your point, 5% on a money market, you can sleep at night and you're going to get your money back for sure. Where we're seeing a lot of cash, but I think that money market, say 5.7 trillion, it's more than double what it typically runs. That could be bull market fodder for equities later next year into 2025. That's how we're viewing it. but it's early on. But you're right. Take the 5% and run.
All right, take the 5% and run. Let's end it there. A nice note. Joseph, really enjoyed this. Our thanks to Joseph Quinlan. He is Chief Market Strategist over at Bank of America's Private Bank. Now, coming up on the close, we'll speak with former Fed Vice Chair Alan Blinder for his insight on what to expect next in the Fed's fight against inflation.
Plus, we're going to talk with the lead owner and governor of the Boston Celtics. We're going to get his insights on the business of the NBA.
And as we head to the close, we'll speak with Christopher Ailman, CIO at Calstrs, the largest educator-only pension fund in the world. All that and more coming up. This is The Close on Bloomberg.
Atlanta Fed President Rafael Bostic weighing in today on the great rate debate. Here's what he had to say. If we reduce too soon or send signals that we are not resolved, we won't get to 2%, and we have to get to 2%. That's non-negotiable. So I want us to hold. That's what the president of the Atlanta Fed had to say a little bit earlier. Let's get some insights out of former Fed Vice Chair Alan Blinder. He's now a professor of economics and public affairs at Princeton University, and a lot has been made out of Bostic's comments here. And one interesting component of that was this idea here that keeping rates where they are, meaning higher for longer, which is effectively what Jay Powell has communicated to the markets here, is really the only way right now to get us back down to 2%. You agree?
Well, I don't think it's the only way. The Fed could really crunch the economy a lot harder, but it doesn't want to do that. It absolutely doesn't want to do that. So it's a far better way. Look, it's not too long ago we can remember that the markets just didn't believe that the Fed was going to go to, say, pick a number, 5.5%, and hold it there for a while. They were expecting instead that shortly after hitting the peak, the Fed would start cutting. That was never realistic, and I think the Fed has now succeeded in getting that thought out of market people's heads.
When you listen to the communication that we're getting, primarily out of Powell, but obviously around the other FOMC members as well, do you think that communication is, I guess, effective in this environment? And I put that in the context of sort of when you used to work for the Fed. A lot has changed, obviously, with the briefings after the meetings, but also just it seems like this deluge of comments that we get from Fed members on a day-to-day basis is much higher than what we had in the past.
Well, it depends what you mean by the past. Right now, there's considerable disagreement on the committee between, call it hawks and doves. That's what it's usually called. That's what you expect at a time when the debate is over how high should we go. That is, some people think we're high enough already. Some people think we need to go higher. We, the Fed, they need to go higher. And there's a vigorous debate going on, and that's where you see disagreements. It wasn't very long ago that everybody saw the Fed had to go up much, much higher. And so there was nothing to disagree about except some details of timing, like at this meeting, do we do 50 or 75 or something like that? Those days are gone. And now the committee is kind of groping for the top. And there are differences of opinion, and you're hearing some differences of opinion.
Mm-hmm. And I'm curious to get your perspective on how much policymakers take a look at what's happening in markets, in particular in the bond market, because, of course, this rapid surge that we've seen in Treasury yields over the past couple months, accelerating again this week, has been hard to ignore. Is that something that policymakers in the room would look at and take a signal from in terms of what market participants and how they're interpreting all of this Fed speak that we're getting?
Yes, with a big qualification. Let me say yes, but about 1/10 what market people do in terms of paying attention to it. I mean, the people on the Fed understand very well that a lot of this volatility is spurious and temporary. Not all of it, but a lot of it. And people in markets, of course, get caught up in it. That's what they're supposed to do. There are a lot of people in markets that are making these prices, by the way, that are in and out of the markets in a half an hour or something like that. That's not a perspective that the Fed understands or cares much about. On the other hand, when there's a protracted upward movement in rates, as there has been, the Fed pays attention to that. But don't forget, that's what they expect to happen when they raise interest rates. So I don't think this is a big, the timing and the action today, that's a lot going on in one day. Are surprises, I'm sure, but I don't think in a broad sense the Fed people are surprised to see 10-year, 30-year rates up around 4.5, 4.8, given where the real rate, the long rate, the real long rate, it presumably is, and the inflation target.
And we only have about a minute left, but I am curious to get your thoughts on the narrative that's emerged that this is an economy that's much less sensitive to interest rates than maybe it has been in the past. Maybe that's why you aren't seeing those long and variable lags coming on the same time frame that maybe we had been expecting to see them. Does that argument hold water with you?
I think it's quite possible, and the main reason I think it's quite possible is looking at what happened in the housing market. In the past, when the Fed jacked up interest rates, the housing market reacted negatively and quickly negatively and didn't reverse right away. This may be just another instance of the pandemic changing everything. It's changed consumer behavior, it's changed financial behavior, it's changed business investment behavior. It's changed who comes to the office and who doesn't come to the office. It just goes on and on and on. And I wouldn't dismiss that as a possibility.
All right, really appreciate your time today. Our thanks to Alan Blinder, professor of economics and public affairs at Princeton University. From New York, this is The Close on Bloomberg.
Welcome back to The Close, a focus on the markets and a focus on the politics in Washington that could affect those markets. The Speaker of the House, Kevin McCarthy, now facing a vote that could remove him from his speakership. A little bit earlier in the show, there was a vote on a resolution to effectively move forward with a motion to vacate the Speaker of the House. Basically, now that resolution is the new resolution now is being debated, Katie, and we're learning that a vote now will come at some point today, or at least that appears to be the plan. I know a little bit earlier we had said that he might have about 48 hours to maybe try to negotiate some sort of lifeline, but it appears that lifeline, at least the timing for it, is a lot shorter than what we said before.
Absolutely, a much more narrow window than perhaps originally thought, and it's interesting. I mean, he's at a crossroads here. What do you do now if you're in McCarthy's shoes? Do you try to appeal to those hardliners on the Republican side, or do you try to win over Democrats? I don't know.
He's in a tough bind, and we kind of go back to January, of course, when he had to, 15 votes just to even get the speakership, which was just a phenomenal number at the time when we heard it. So he made a lot of compromises just to get this job. And we knew that there was that risk, because one of the big compromises that he made was basically allowing for what is effectively the procedural vote we had today, where one person could stand up and say, I don't want you here anymore. And that, for whatever reason, you could bring that to the floor of the House. And that's the state of our democracy right now.
And here we are 10 months later, of course, at a very tenuous time, of course, heading towards that next deadline where we could be looking at another government shutdown.
Would you like to be Speaker of the House?
Yeah. No one's called me.
I mean, you're very diplomatic. You have a good personality, make people laugh.
I'd take a stab at it. This is Bloomberg.
This is the countdown to the close. 30 minutes left to go here in Tuesday's session. A session right now with stocks at session lows. Katie, a lot of volatility in the market today.
A lot of volatility, to put it mildly. The S&P 500 currently off by about 1.6%. Just utilities in the green, which is actually surprising because utilities have been absolutely hammered over the last couple of weeks, but managing to hold on to gains right now. That's the good news. You go down to the list. It's red, a sea of red, if you will. You take a look at at what's dragging us lower. Information technology, consumer discretionary, and I don't know what not classified is, Romaine, but it's not doing too well.
Yeah, they need to definitely get it in gear, whoever that is down there. Meta Platforms and the rest of the Magnificent Seven not doing much here for the market as well. Down about 2%, and that really is the story, quite frankly, for this broader market here on this Tuesday afternoon. Interesting story here going on with McCormick, the spice trade down 8% here. The guidance that it gave, particularly when it comes to its business in China, not doing so well. And that's interesting to me because this was always considered to be one of those companies, one of those stocks that was kind of recession proof, right? That even if times are bad, people still eat and people still want to spice their food. But apparently that's not necessarily the case here. This is not just a revenue story, but also a margin one as well. Meanwhile, two interesting upgrades today. An upgrade for Wingstop, but unfortunately investors aren't buying it. The analyst was pretty bullish on the idea that sales growth is about to reaccelerate. Nevertheless, investors seeing something that they don't like, down 4%. And a double upgrade over at Bank of America for HP Inc. This is HPQ. So those shares holding on to most of their gains, up about 2% right now, though they were much higher a little bit earlier. Of course, what really caused a big part of the sell-off today was what happened around 10 a.m. New York time when we got the latest JOLTS data. Basically, this is the number of job openings out there. You can see the white line here. The number of job openings had really peaked late last year, early this year, and then started to come down. But now you see that reacceleration, about 9.1 million jobs out there remaining to be unfilled. That's up from less than 9 million the previous month here. And you see these purple lines here, that's wages here. And this is the big conundrum right now for the Fed. You have unemployment low, you have the quits rate low, and then you look at the average wage growth continuing to be elevated here at a time when job openings are starting to reaccelerate. 4 weeks out from a Fed meeting, guys, it's going to be an interesting conversation come the end of the month.
Well, we're a few weeks away from a Fed meeting. We're also a few weeks away from the start of the NBA season. The Boston Celtics slated to take on one of its regional rivals, the New York Knicks. For more on the business of sports, I'm thrilled to say we're joined by Wyc Grousbeck at the Greenwich Economic Forum. He, of course, is the lead owner and governor for the Boston Celtics. Wyc, it's great to have you with us, and I'll start with a softball. How are you feeling just a few weeks away from the start?
Well, so excited. We made a major trade over the weekend. We hope it's finalized later today, formally inked. And we really love our team, love the roster. Everybody in the league feels great in early October. We're all undefeated, but we hope this could be a strong year for the Celtics.
A strong year for the Celtics. And talk to us a little bit about valuations in terms of players right now. How has that changed over the past few years versus when you took over for the Celtics?
Valuations of players, maybe meaning their salaries increasing?
Yes, in terms of trading, for example.
Oh, and trading for them. Well, the superstars and the very best players are global superstars of the NBA. You know, some of the 10 or 20 most famous people on the planet, and really drive our whole, business of offering entertainment to people. We have great stars in the game now, and we share our revenues with our players, and they share them with us in a sense, and we really have a nice partnership. So I'm thrilled to see players be super well paid and to be performing on a global stage. I mean, I've been in the league 20 years and it's grown so much and it's been such a joy. So I feel very, very fortunate.
When it comes to the media partnerships here, Wyc, and I guess how people consume sports these days, we know, of course, some of the traditional networks still kind of have a hold on that. But we know a lot of people have just gravitated to different platforms. So when you go in there and you're having these negotiations on new media deals here, what exactly do you want to see? Like, what do you think would be most beneficial to not just to the Celtics, but to the NBA overall?
Well, I'm on the media committee at the NBA, but we're not allowed to talk about anything that's going on. We'll be negotiating next year with our existing partners and then potentially with new partners next spring. But in general, what I'd like to see as a team owner and as a longtime fan of the NBA is I'd just like us to see to keep globalizing. We have almost, I think, 40% of our league, our players, come from overseas. We've got fans in 210 countries around the world who get to stream our games now, but we think that the international growth could be really super exciting. We're doing great in the United States, and we appreciate the fans here, but the global game is, the global attention is really turning to the NBA as well.
It is, and I mean, obviously the Celtics, to a certain extent, at least through history, have sort of been a big component of that. I mean, I'm going to date myself, but when, coming of age, I mean, it was basically the Celtics and Lakers and the Bulls and the Pistons and that sort of bad boy era here. And, I was watching the most recent documentary, or not documentary, I should say, the most recent show about the Lakers, which I guess could be a documentary if you wanted to be here. It had an interesting end to it. I mean, the Lakers somehow were overtaken by the Celtics, which, I don't know how the Lakers
That's what happened in 1984. My wife and I were watching. We were thrilled that second season of Winning Time contained 2 Celtics championships. And, we're great friends with the owner of the Lakers, Jeannie Buss. She's a close friend of ours and our partner in our Cincoro tequila, as a matter of fact. And so we're friends, even though we're competitors. And we've had 2 finals against the Lakers just in the last 20 years that I've been around. So they're always a lot of fun. Love to have another one.
And Wyc, have you thought at all about investing in other sports or other leagues?
I have back in the day. I looked at an NHL team. I looked at with a partner or 2. We looked at some soccer. We looked at some hockey. But really, the Celtics is more than enough for me. I really am the day-to-day CEO as well as the governor, and so it's my responsibility. When it goes badly, for sure, you can blame me, and I blame myself. So I spend a lot of time on the Celtics and care deeply about it, as anybody should who's trying to run a team like this.
All right, so let's talk about the season here. Katie mentioned at the top here, the tip-off, I think sometime at the end of this month. You guys obviously got Drew Holiday. That was a big trade. Of course, you got Porzingis, who I don't think anybody has any doubts about his abilities, Al Horford and Jaylen Brown, and I think Tatum is on that roster as well here. I mean, what do you think your chances are? I mean, I know you're going to just say, of course, we'll win, but I mean, when you look at that lineup here, I mean, how do you think they really are going to stack up against the other dominant teams out there?
Well, I don't want to jinx it. I wouldn't say that we would win in any case, but I will say that Las Vegas has us sort of as co-favorites with the Bucks. We're thought to be the 2, but then just behind us are a couple other great teams, and then it goes on from there. So we really like our chances. We've improved our chances, we think, with some of the moves, although we let go some really terrific people. Players who happen to be great people as well. Mm-hmm. And, these trades are difficult, but it's really the most challenging part of the job. But we hope we got it right this summer. We hope we can really make some noise. We love this team and love the chance to go out there and compete.
All right. Well, best of luck, Wyc. That is Wyc Grousbeck. He is lead owner and governor of the Boston Celtics. Meanwhile, in the world of golf, SoFi Technologies has reached a sponsorship deal with TGL. That is the tech-focused golf league backed by Tiger Woods. Now, SoFi will lend its name to a new arena on the campus of Palm Beach State College in Florida. The SoFi Center is expected to accommodate about 2,000 spectators, Romaine.
Mm-hmm. Yeah, I'm actually looking forward to this. I mean, this is kind of interesting. And they got some big investors, including like Stephen Curry and Alexis Ohanian and a few others here. But just the whole format. I mean, because there's always been this idea that golf tournaments, at least televised golf tournaments, aren't always the most scintillating thing. I mean, they're drawn out over 4 days, several hours per day. If you're not a golf fan, it's hard to kind of know exactly what's going on and why. And this is a more truncated version of that. 2 hours. It's kind of in a contained space here. There's a lot of, I mean, at least based on the render and seeing a lot of little flashes, electronics, and other things like that. I guess this is sort of a golf for the new era. Is that going to make you a fan finally?
No, I was going to say, I don't know if that's enough.
What if they're wearing Hokas out there instead of golf
Yeah,
kits?
maybe. And if there's like some horses on the golf course, I would maybe tune in.
So we call that a hazard.
Yeah. Well, in any case,
you don't want to hit the horse.
Something to think about. But coming up on the close, we're going to talk about
I'm going to
M&A
think about this a lot.
Activity in the pharma sector. Eli Lilly strikes a deal with Point Bio to buy the company and expand its portfolio. It's our stocks of the hour up next. This is the close on Bloomberg.
Time now for our stocks of the hour. Eli Lilly and Point Biopharma in focus right now after Eli Lilly struck a deal to buy the company for about $1.4 billion. Lilly gaining access to radiation treatments for cancer patients, and Point Bio sees its biggest gain since it began trading back in 2020. Joining us right now is healthcare reporter Madison Muller, joining us from our Chicago bureau. And let's start off with what the impetus for this deal. I know it's the dream of every small biotech company to finally get bought out by one of these bigger ones here, but what exactly was Lilly? What pushed Lilly to do this deal?
Yeah, so Lilly has previously said that it is going to focus on doing deals in areas that the company knows best. And so even though a lot of the focus recently has been on Lilly's diabetes and obesity business, it does have a very big oncology business as well. And so Point's assets that Lilly is interested in are these drugs that deliver targeted radiation therapy to cancer cells. And ideally, they do less damage to the body because they're only targeting those cancer cells and not, having other side effects that some other cancer treatments have.
Let's talk about the price tag a little bit. Like Romaine mentioned, $1.4 billion. Lilly is going to pay $12.50 a share in cash. That is 87% higher than Point's closing price on Monday. What has the reaction been to the price tag so far?
Yeah, so from analysts, what I've seen is that the reaction to the price tag is that this is a fair deal on both sides, actually. And it's in line with some of the other recent deals that Lilly has done. It acquired Dice Therapeutics recently, as well as Versanis Bio. And Versanis makes an investigational obesity treatment, and Dice is a autoimmune disorder-focused company. So all of these are sort of areas that Lilly is already, in and has business in, and similar sized deals when we're looking at it like that.
All right, Madison, great to catch up with you. Madison Muller there, a healthcare reporter for us out in our Chicago bureau. A discussion here about our stocks at the hour, Eli Lilly and Point Bio. Point Bio having a phenomenal day, up more than 80% on the back here of that acquisition deal. Meanwhile, we count down to those closing bells, about 15 minutes until we get there. Christopher Ailman going to be joining us. He's the Chief Investment Officer over at Calstrs. Unfortunately, joining us on an awful day right now for the markets. Near session lows for most of the major indices, with the NASDAQ down about 2% on the day. The S&P and the Russell each down about 1.5%, and a big part of the reason, the updraft that you're seeing in the dollar and the updraft that you're seeing in yields. Your 30-year yield up 15 basis points right now, the 2-year up 4. This is Bloomberg. This is the countdown to the close. Romaine Bostick here, joined now by Scarlet Fu, as she does every day at this time. Scarlet, you've been away for the last couple of weeks here on vacation to wherever, Sardinia or wherever you go with your family there. You miss a lot here. There's been a lot going on in the markets, and a lot of that has to do with this big updraft that we've been seeing in yields as well as in the dollar. That's had a huge impact, of course, on equities. And today is now, at least in this current little cycle that we're in, is probably the worst of those days, with the NASDAQ down 2% and S&P down 1.4%. And last time I checked, something like 60% of the members of the S&P 500 now back below that 200-day moving average.
Yeah, and the S&P 500 itself approaching breaking below that 200-day moving average as well. I feel like when I went away and I came back, everything that was already in place just accelerated, right? The collapse in stocks, the collapse in bonds just took off. And then, of course, you have the dollar continuing to build on its gains. Is soft landing still the default assumption here?
I mean, if you believe certain members of the Fed, I mean, look, I don't think the problem is that nobody really knows, right? I mean, you can look at this economic data and make a case for a soft landing. You can make a look at this economic data and make a case for a recession, an imminent recession.
Well, the data, the JOLTS data would suggest that we have a soft landing, but if you stay higher for longer, which is what so many Fed officials are hinting at, then that could turn into a hard landing eventually, and maybe even suddenly as well.
Yeah, let's get some insights out of our next guest. Christopher Ailman is joining us right now. He's a Chief Investment Officer over at Calstrs, which has, I believe, is something like more than $300 billion in assets under his tutelage there. Chris, I do want to start off kind of what the market is trying to price in, because it seems like, okay, rates go higher. I understand that changes valuations. The Fed says we're going to keep Treasury rate, or keep the benchmark Fed funds rate at this higher level for longer. I understand that scares some people, but to see this type of sell-off, I don't understand what dramatically changed over the last few weeks to cause this type of sell-off.
Well, Romaine, and it's always good to talk to you. Today's a day where if you like to buy low, then you get an opportunity later on to sell high. But I think these kind of sell-offs are part of the market's volatility, the fact that so much is computer trading and program trading. So when there's a momentum like the JOLTS report that came out and the market sold off, then it just carries throughout the day. And as Scarlett said, you've got to watch. We're getting close to that 200-day moving average on the S&P mini futures. And my trade desk says, 42.22 is a really critical level. See where we close today, whether we hold that or not. Then if not, we're going to test lower lows, and that really will wake up the market.
Yeah, we actually traded below that level at one point intraday. I am curious, Chris, about this idea of the correlation that we're seeing right now, the negative correlation, I should say, with higher yields, lower stock prices, higher dollar, lower stock prices as well. Does that feel, at least in your mind, the way it should be in this particular moment?
Romaine, I've been telling you for almost a year now that yes, it does. I've been thinking that, you don't fight the Fed. The Fed's been raising rates for over a year. My gosh, it finally is starting to show up in the market. I've been saying you got to look at the bond market. You got to look at the bond market. Look at the bond market. I mean, and look at the long bond is getting close to 4.95. Yeah. Short end of the curve, definitely through 5. And yes, we're probably going to get a rate hike, but you're going to hear a lot of talk as we get close to October that's the last rate hike. But rates will stay higher for longer. I still can't tell you if we're going to have a recession, but I think equities got ahead of themselves this year, and now we're going to end up. They may give up the whole gain on 2023. We'll see.
So, Chris, as we try to make sense of what's happening in the markets today and also what's happening in Washington as well, what kind of impact do you think the dysfunction that we're seeing in our nation's capital is having on price action? The near shutdown, the 11th hour agreement, the now attempt to oust the Speaker of the House, it's definitely not helping. Is it enough to, say, lead Moody's to downgrade the U.S.'s credit rating as well?
Well, Scarlett, I think Moody's has to catch up with the rest of the rating agencies, and it's obviously dysfunction. But it's sad, but Wall Street likes dysfunction in Washington because they don't want to see big spending. They're also a little bit afraid of big cuts. We'd like to be nice to see a balanced budget every once in a while. Good grief, we're such deficit spending. But I don't think I listened to Romaine's discussion with Katie earlier, and as much as we care from a citizen standpoint, I don't really think Wall Street cares that much what goes on with the Speaker in the House, other than seeing a stalemate and gridlock. Sadly, we're really used to that.
Yeah.
What Wall Street's looking at are interest rates. The Fed is data dependent. So the JOLTS report today, in terms of white-collar employment being strong, and then the employment numbers coming out this Friday. Thank goodness the government's open. We'll get numbers this Friday, and we'll see where unemployment is. I'm really watching weekly unemployment claims on Thursday, not the week-to-week, but the 4-week average. Yeah. I've been telling my board, keep your eye on that. That really is going to tell you if we have that soft landing or whether we have a tougher recession.
Yeah, well, we'll be relying on those high-frequency data points if the government does shut down after November 15th, if there is no speaker and they can't get any kind of spending plan agreed upon. So, Chris, in this kind of market, given what we're seeing with the sell-off, where do you hide in this kind of market? Bond proxies like utilities, at least for today, do appear to be a bit of a safe haven, but, overall, fundamentally, they are big victims of the higher-for-longer environment.
Well, Scarlett, I always have to make the point to the viewers that I'm not a trader, we're investors. So we are long-term. Think of your retirement account, your 401ks, that's what we do. And so we diversify. We like fixed income in here. We like cash as a short-term staying place in here. And from my perspective, fixed income moving out the curve, today are those kind of opportunities. I mean, when the long bond's off 2 full points, that's a huge move in the bond market. It's an opportunity to come in and buy low and then hold on to those. Trading them is going to be really tough in here, but we like private credit. We like diversification, non-U.S. versus U.S. And then obviously with these currencies, you're down now at the bottom of some ranges in some currencies. Maybe it's time to move a little bit out of dollar assets into non-dollar assets. So put all your eggs in more than one basket. Don't just stay in the Magnificent Seven in the U.S. and don't just stay in the U.S.
All right, Chris, I think we're going to have to leave it there. Always great to catch up with you. Christopher Ailman there. He's the CIO over at Calstrs, helping us count down to the close here on a Tuesday afternoon. Scarlet off the session lows here, but the damage is still done here. The only S&P sector among the 11 right now, utilities, up about 1% here on the day.
But it's worth mentioning that utilities are the worst performers for the past month, for the past quarter, for this year. So that kind of performance maybe has sparked a couple of analysts to say it's time to consider buying them, but as bond proxies, it's not great right now.
And we should point out, this is definitely a very technical-driven market right now. We talk about some of the key moving averages in play. You have a VIX elevated back near that 20 level here. But again, I think what we're seeing in the rates market, just phenomenal. 15 basis points on a 30-year yield just in one day.
You know, I should go away again and come back. Everything will be above 5% at that point.
That's right. I don't know. Maybe that will be the case for the rally here, but stick with us here on this Tuesday afternoon. We are moving closer to those closing bells. Our full market coverage right here on Bloomberg as we take it to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Massar and Simone Foxman filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms. Carol Massar, stocks pretty much where they are. Last time we spoke about an hour ago here, not far off session lows.
Yeah, not seeing any buying, right, in the last few minutes or last hour of trading. No, not at all. What's interesting is we just talked with Aaron Kennan over Clear Harbor, and, you know, he said the kind of instability we are seeing in Washington, he does think about it, and he says it doesn't really instill much confidence, if you will, when it comes to investors. He said we're looked at as a country that there is compromise, that we are able to find common ground. That's the history of this country. And so he does think about it a little bit when it comes to certainly how it can impact investments and maybe how he trades for his investors.
And you have to wonder if investors are just focused on the scenes playing out, the debate happening on the House floor in Washington as we get, you know, this debate around the motion to potentially vacate the speaker. Everyone is kind of holding their breaths a little bit right now.
Yeah, we averted a shutdown this time around, but no one knows what's going to happen in mid-November when the spending plan then expires once again, the stopgap measure, and we can do this all over again.
Yeah, and I think leadership is important. We were speaking with Christopher Ailman over at Calstrs. You know, he makes a point that, you know, Wall Street, of course, tends to shrug off a lot of the nonsense that goes on in Washington, but we're talking about a speakership here that was already somewhat tenuous from the time he took over in January, and it's not quite clear who's going to take over for him and whether they're going to be somehow more cooperative, or what's the phrase you use, Carol? Something like about compromising.
Common ground,
Common
right?
ground, yeah. And I'm not sure. I mean, I feel like the deal McCarthy made was indicative of the common ground we need to see more of. Yet, of course, the people forcing him out are forcing him out because he went out and found that common ground.
Exactly. Right.
Dow Jones Industrial Average down 1.3% on the day, more than 430 points lower. We're going to close right around that 33,000 level. The S&P 500 lower by 60 points or 1.4%, closing right around 4,229. The NASDAQ Composite lower by 250 points, down 1.9%, closing at 13,059. And the Russell 2000 also down about 1.7% here on the day, closing out at 17,027 or 1,727.
I'm just going to say this is the kind of day where I don't have enough. I said this to Simone earlier. I don't have enough screens on my Bloomberg to kind of keep track of it all. Having said that, Romaine, great read in terms of the final numbers for those major equity averages. S&P 500.
Sorry, I just want to interrupt you just to
please.
go back to the speakership here. We are now learning that the actual vote to remove the Speaker of the House, Kevin McCarthy, is now beginning to take place. It's going to obviously be several minutes before we actually find out exactly what that vote is, but it's important for our viewers to know this is what's now taking place in your House of Representatives, a motion to remove the Speaker of the House, something that hasn't been done, not a vote that has not been done since 1910.
Right. We say unprecedented times, and you do wonder, like, what does this mean? What happens next? And that we're not seeing this common ground being found, this support, so that lawmakers can go about the business, the responsibility of their job to actually govern, find policies that are beneficial to everyone. So this is a rough time, I would say, again, in our history. Having said that,
and I'm sorry to interrupt you again, but I mean, this matters. And I know there are a lot of people in the markets will shrug it off here. But what you're watching right now is something that we have not seen in more than a century. And we should point out here, too, that just the procedure taking place right now, what they're doing, they're actually taking one by one a roll call vote of everyone. So normally everyone just kind of walks up, hits a button, and then they kind of move back on here. But they want this on the record, every single person here to know how they voted one by one here. So this is going to be a relatively long process that could go on for quite some time before we know the results.
They want their constituents to see them voting no or yes in support of the speaker, the current speaker, Kevin McCarthy. And of course, this is happening right as we close the market on a very down day. You look at the number of decliners compared to advancers, more than 4 stocks lower for everyone that is down for a second straight day, Simone.
Yeah, I mean, there was easy to find some decliners today. Looking at Getty Images, that was getting cut to neutral at Redburn Atlantic. We saw a slowdown in sales there that apparently seems to be connected to slower advertising sales at firms like Google, Meta, Amazon, Snap. Their price target now $6 a share. We're looking at $5.61 right now, but that was after it was down about 12% today. Dish Network also taking the heat, shares down 7.9% we're looking at. Falling all day, 2 potential catalysts. Dish Network is actually the first company to be fined for space debris. It left a satellite in the wrong place in space. That's a $150,000 ticket.
How do you leave a satellite in the wrong place?
It's in the wrong space in orbit. It was a retired satellite, and they left it there.
It didn't have one of those Apple white discs on it where you can find everything.
It did not have an AirTag, or at least a working one, no. But also the company amending its merger pact with EcoStar. That's a $4 billion deal announced in August. EcoStar shares.
You have McCormick on this screen. That's a spice company?
It is
Why
indeed.
are they down? Have we stopped buying spices?
Lowest close since March 2020, actually. Net sales, coming in behind the average analyst estimate, but in particular, folks in China have stopped buying or aren't buying as many as the analysts expected as buying spices. So China's economic recovery apparently has been slower than anticipated. That according to execs at the company, and we're looking at shares down 8.5%.
All right, so quickly to some of the gainers in today's session. This is a big one. I feel like this is the year where a lot of news has come out when it comes to the biopharma industry, whether it's deals or whether it's actually announcements about drug development. So let's get to Point Biopharma surging about 85% in today's session. Eli Lilly agreeing to buy the biotech company, $12.50 in cash. The stock just finishing below that level in a bid to expand its oncology capabilities in radio ligand therapies. And I want to mention Lantheus Holdings because that holds the worldwide license to Point Lead's drug assets. So it also jumped about 10% in today's trade. Intel saw it top of the NASDAQ 100. We saw a note to clients from KeyBank Capital that was out yesterday, which noted that NVIDIA and Intel are bright spots in a soft semiconductor chips market. So Intel, slight gain there, up 0.2%. And Warby Parker up about 3.4% in today's trade, upgraded to outperform from inline at Evercore ISI. They also announced a $20 price target for the company, and the stock finishing at 13 and change, just under 14. About 9% of the float is shorted, though, guys, on that one.
Yeah, let's go to the yield space here. And I actually want to start off with that 30-year yield. Right now, sitting at a higher by about 14 basis points than where it was just yesterday. 492 and change. At one point on the day, it flirted with 5%. And we should just point out, on an intraday basis, it was up about 17 basis points here. That was the biggest move that we've seen, higher or lower, going back to at least, it appears, since March or April of this year. And we saw similar moves on the longer end of the curve as well, with the 20-year up about 13 basis points. Your 10-year up about 12. And meanwhile, the 2-year yield only up a measly 4.4 basis points here on the day. And it really begs the question here about that negative correlation that we're seeing between the yields, higher yields, and of course, lower equity prices here, and how much this is going to persist going forward.
Yeah, and you know what always gets my attention? The fact that the 20-year yield is such an outlier. It's yielding more than 5.10% compared to the 10-year and the 30-year. Of course, I asked Katie Greifeld about this, and of course, she had written a story about this not so long ago, but it has a lot to do with the lesser liquidity in that tenor.
Yeah, right, because it's not kind of, you look at those numbers and you're like, what's wrong with this read? Aaron Kennan, when we talked with him over at Clear Harbor, pointed that out, like it was an interesting kind of standout among the Treasury trade today.
I just want to mention, too, guys, just crossing the wire right now, some news on Intel, a redhead crossing the Bloomberg terminal, saying that the company is going to separate its programmable solutions group operations. Basically, it's going to operate it as a separate business here under the leadership of Sandra Rivera here, and that will begin on January 1st. So basically spinning off more or less its programmable solutions group beginning January 1st here. I don't know a lot about this particular division or exactly what it does, but
Stocks up 2.7% in the aftermarket.
Yeah, so investors seem to like it, I guess.
But this idea of spinning off companies hasn't worked out very well for a lot of the companies that have been spun off, right?
Well, it depends on what the name. I mean, is it going to be like Intellanova or something like that, or
Intel 2.0?
Yeah.
And you actually
I'm
look
still
at
trying to figure out what Kellanova is.
It's not Kellogg.
Because it's
That's
like
the point.
snack foods. It's like, I mean, they could have named it Pringles. That would have been like very, very well, right? I mean, Pringles. Everyone knows Pringles, but Kellanova.
There is a WK Kellogg, not to be confused with WK Kellogg, but frankly, if you look at shares of companies that have spun off recently, Veralto, Vestis, Kellogg, they've all had these, WK Kellogg, they've all had these issues. For example, Veralto, this is its second day of trading, shares and closed down 9.5%.
Yeah, this is all about unlocking value. In a couple of years, they'll be back to unlocking value by combining everything, and everyone will be in love with conglomerates once again.
I don't know about you guys, but there's a lot going on, and we ain't even over yet.
I know. I got to get some Kellanova special cake.
Kellanova for everybody. That would be a good cocktail name. I'd like a Kellanova.
A Kellanova.
Yeah.
I think of it less than cereal, but
yeah, it doesn't lend itself to snacks.
It sounds like a satellite that someone misplaced in space.
Floating around.
All right. We got to run.
I got a lot more jokes, Carol.
I can tell, like, 2 shows daily or nightly or whatever you say. All right, guys, that's a wrap.
Carol only works a 3.5-day week.
Stop that. You know I'm here a lot. All right, that'll do it for our cross-platform coverage.
She didn't say 5 days a week.
Radio, TV. Hey. Radio, TV, YouTube, and, of course, Bloomberg Originals. We'll see you again, guys, tomorrow.
All right, stick with us here on The Close. We have special coverage coming up right now of the future of Kevin McCarthy, the Speaker of the House of Representatives here in the U.S. An extraordinary vote right now taking place in the House of Representatives to remove the Speaker of the House using the procedural measure that hasn't actually been implemented in more than a century. We'll have that full coverage coming up after the break. This is Bloomberg. A lot of people looking for the floor in the U.S. equity market. They did not necessarily find it today. Down about 2% on the NASDAQ, down 1.5% or so on the S&P. And when you look under the hood here at the individual members in the S&P 500, more than 60% of them right now are trading below their 200-day moving average. That's a huge flip-flop from where we were, quite frankly, just about 3 months ago. Remember, you go back to late July here, you were talking about a market right now that was flirting not only with 52-week highs, but you had individual stocks flirting with record highs. That has completely flipped the script right now, and that includes even the Magnificent Seven. All 7 of those stocks in the red today, including Amazon, which dropped almost 4% here on the day. Microsoft down about 3%. Tesla down about 2%. That was the savior for the market in the first few months of the year, along with a few other of the big tech cohorts. But we're seeing a lot of weakness there, not necessarily because of fundamental reasons, but more of a technical driven factors right now as people look at those valuations for some of those names, overlay them with what we're seeing in the FX space with regards to this dollar strength, overlaying them with what we're seeing in the treasury markets here. You mix them all up together here and you get that re-rating. We saw that a little bit earlier today with that 30-year yield flirting with 5%. In fact, right now you have 2 key points on the curve right at 5% right now, and 2 other key points on the curve right now looking like they could poke above it pretty soon in short order. You saw that reflected in volatility in the equity space with the VIX, which tracks the volatility in equities on a forward basis. Look, right now camped out around 20. That may not seem much, but when you consider how dormant it's been for a good portion of the year, going up to 20 is significant here. There was also, of course, a lot of volatility that we saw in the yen. At one point here on the day, we broke 150. That was right around 10 a.m. Eastern when we got the JOLTS report here in the U.S. That had an outsized effect on the dollar and on the yen, but in a span of about 4 minutes, you went from basically the lows of the day, 150.16, all the way down to the lows of the day within 4 minutes here from 10:06 a.m. to 10:10 a.m. We don't necessarily have the reporting to confirm this, but the speculation is that there had to have been some degree of intervention to flip-flop that back to where we stand right now at 148.82. A volatile day in the markets here, Scarlett. It'll be interesting to see what happens over the next few days.
Absolutely. But for now, all eyes are in Washington right now, where we have breaking news because Speaker of the House Kevin McCarthy is really in the political fight of his life. There's a House vote underway on a motion to remove him as Speaker. This is the first time a vote has taken place in more than 100 years. The last time this happened was 1910. So joining us now with the latest is Anne-Marie Hordern. She is co-anchor of Bloomberg's Balance of Power. Anne-Marie, in order for Speaker McCarthy to stay Speaker, he needs to get support from his critics on the far right or his critics in the opposing party, the Democratic Party. Is there any evidence that he's managed to shore up supporting votes from either of those parties?
Not at this moment, because earlier today in the afternoon, there was a rule that was put forward to move forward with this motion to vacate. And in that rule, that provision, he lost 11 Republicans. So everyone said potentially he can lose 4 or 5. He lost 11. Now, maybe that was some posturing. Maybe those were individuals who wanted to make a point to show the Speaker McCarthy he had to placate a little bit more to the hard right flank of his party. But that was a show that he was going into this with not enough numbers to really shore up his position. Now, potentially, what could be happening, even though they are having this roll call, that means every single individual, every single lawmaker has to get up and say how they want to vote. We just heard from Lauren Boebert, and she said no for now. Not exactly sure what that means. Maybe in the future she's willing to have a Speaker McCarthy. Yeah. But he could be trying to cut some backroom deals with Democrats. But the issue is the Democrats are going to want a bigger say in really how the entire institution is governed. And that was something that earlier today McCarthy said that he just wouldn't surrender.
Wouldn't surrender. All right. I'm curious here, Anne-Marie. Let's just kind of push ahead to this, because I don't understand what happens if, for some reason, this vote succeeds, meaning that he is actually removed as Speaker, vacated, essentially. And I think that's the key word here. What can the House actually do if the speakership is vacant? Can they do any sort of normal business without that role being filled?
So you're watching history being made here if we are going to see the ouster of Kevin McCarthy. There is a list, a pro temp list, which started after 9/11 in the event of potentially a terrorist attack to have continuity of government, that there would be someone outside this body or that would take over and be the Speaker. Potentially you can see that, or they just start the rounds to try to elect a new Speaker. But remember how difficult that was earlier this year when Kevin McCarthy won after 15 rounds. So once he is ousted, though, that means the Speaker chair is empty. So it's almost uncharted territory, what we're looking at right now. This is the pro tempore list. What we do know is that Speaker McCarthy has put the names on that list. Yeah. We, the public, do not know, but he for sure knows the name he put on that list. And then it's whether or not the Republicans can coalesce around a leader. And the issue they have...
Anne-Marie, I mean, when we talk about sort of who could potentially be on that list, in theory, you would think they would just kind of go down in seniority. So that basically would mean Steve Scalise could potentially be the person, Tom Emmer, I think Gary Palmer's on that list as well. I am curious here about this idea of whether the sort of uproar that you had around McCarthy's nomination to be Speaker, how many votes it took, whether any of those names would have an easier time, I guess, placating the far right, faction of this party.
Potentially some of them could, because many point to the fact that they truly believe that this is, even though he says it's not, that Congressman Matt Gaetz, who's really been driving this motion to vacate, many believe that this is quite personal with him and Speaker Kevin McCarthy. And that was on full display earlier this year. Remains to be seen if anyone is going to have enough votes. Some of the members you just listed, Scalise, Emmer, will they have enough votes to push this forward? But also those individuals spoke just this past hour in favor of Speaker McCarthy. The other point of this is the fact that you would think maybe it would be Steve Scalise. Remember, Kevin McCarthy held Steve Scalise's position when John Boehner resigned. He was House Majority Leader, and McCarthy didn't have the votes back then in 2015. So Also, Scalise is being treated right now for blood cancer. There's so many individual stories that are going on right now in this conference. And I think the most important thing you have to keep in mind is how slim the Republican majority is right now. And that is why it is so tough for Speaker McCarthy. Yeah. And even if there's another leader, it'll be very tough for that individual as well.
Okay, so if that's the case, and you mentioned Lauren Boebert voted for now, which is an interesting way of putting it. Is there any evidence that Democrats would prefer to see, I guess the devil they know, keep on Speaker McCarthy despite what they see as a lot of betrayals in terms of how he's managed his role, as opposed to having no one and having just this vacuum?
Well, what we saw from the rule, and I think what you're seeing and what we'll see depending on how the Democrats vote, is they're not going to back Speaker McCarthy. While, yes, it does seem to be that Hakeem Jeffries and Speaker McCarthy, Hakeem Jeffries is the majority leader for the Democrats, have a very cordial working relationship. Mm-hmm. They talk about the fact that they get along. And, they try to put politics aside in that relationship. It is true, potentially Hakeem Jeffries would like to see him be speaker. But politically, this does not work for the Democrats to come out and support a speaker. Remember, he just launched the impeachment inquiry. There's some that are very upset that Ukraine aid wasn't put into this continuing resolution they voted on this weekend. Right. Politically, it's really untenable for them to go and vote for Speaker McCarthy.
Okay.
But let's see what the end of the week or next week brings.
Ends up replacing him would probably do not only exactly the same things, but probably even more.
Well, potentially, yes. We also should remember that the Speaker of the House does not have to be a member of Congress. Romaine, you could be the Speaker of the House, potentially.
You know what? Let me be the Speaker of the House. Thank you. I have your vote, Anne-Marie Horton.
Yeah. I mean, I think it'll be a little bit more organized than we're seeing today.
Yeah. At this point, a panda bear could be Speaker of the House, and it'll probably run better than what it's being run right now. Anne-Marie Horton, we'll check back in with her again as co-host of Balance of Power, and of course, they're going to have full wall-to-wall coverage a little bit later on Balance of Power. Anne-Marie Horton and Joe Matthew, including sit down with several members of Congress, including Congressman Mike Lawler, as well as Henry Cuellar. We're going to have a lot more coverage coming up right here on The Close with myself and Scarlet Fu as we get a little bit more insights into the vote now taking place to remove the Speaker of the U.S. House of Representatives, and more importantly, who would replace him and what would come next. This is Bloomberg. Continuing our special coverage right now of a vote taking place in the U.S. House of Representatives to remove the Speaker of the House, Kevin McCarthy. Let's get some insights out of Terry Haines, the founder of Pangaea Policy. And Terry, this really isn't, at least for the markets, so much about Kevin McCarthy himself, but it's really about the functioning of our Congress, which as of late doesn't seem to actually be functioning in the best interests of this nation.
Yeah, I think that's absolutely right, Romaine. The Washington antics here, the dissident Republicans and all that, vendettas are all very nice, but they're political small ball compared to what the markets are concerned about, which is firstly that Washington keeps demonstrating that it can't govern. I mean, it can't even do the basics like fund itself for an entire year. That's a bipartisan failing, by the way. Anybody that thinks it's partisan one way or the other needs to understand everybody, and I mean everybody in Washington, left for 7 weeks in the summer instead of doing their jobs. So it's on all of them, number one. Number two, there's a greatly increasing concern in the markets that Washington can't right-size debt, deficit, entitlements, and their annual spending. And what they see in this process is nobody, and I mean nobody, trying to right-size that in any sort of meaningful way. So what you're seeing today actually helps in a negative way, helps the markets conclude even further that Washington's reputation and its ability to do its jobs is being degraded and probably continues to be degraded. So that's a serious market negative, I think.
Yeah, so this, I guess you could call it political impotence in a way, is what prompted the S&P rating company and Fitch to downgrade the U.S.'s credit rating. Is this something that's going to lead Moody's to do the same? I wonder whether either party sufficiently understands and appreciates the risks of that happening.
I'll take the second part first. I think the answer is that they do not understand and appreciate sufficiently the risks of that happening, or what happens as a result, which is that lending becomes more expensive, all the rest of it. And this is at a time when there's, as you all know, because you cover it every day and talk about it, where not only do you have the credit ratings downgrade, the United States has to roll over almost $8 trillion in debt in 2024 and fund new debt issuance. Banks are underwater on bond holdings. Commercial real estate sector is under increasing pressure, and and the central banks are doing their jobs, but those jobs are adding to those pressures. These people are acting obliviously, and it's a bad look for the United States, and it's more than a bad look. It begins to put meat on the bones of a narrative that the United States governance is past it, and really can't do anything about any of this.
Well, I am curious, though, as to sort of what rights this ship, Terry. And we should point out, just from a historical context, there's always been a lot of dysfunction in Congress. There are a lot of great stories back from the 1800s of them sort of beating each other up with baseball bats. So thankfully, we don't allow bats on the floor anymore. But I am curious.
I've been in the body when they people slapped each other, though. By the way, it gets a little heated.
Yeah.
Anyway.
Is there anything, though, that changes that? Just the political functioning? Is it the voter? Is this up to the voters, or is it up to some sort of higher power to finally sort of make us all sort of see the way?
Number one, it is up to the voters. But one thing I said to your colleagues on surveillance this morning, by the way, is that I think what is underestimated now, when you're seeing these purists on both sides wrangle the way that they're wrangling now in the McCarthy matter, that there's a substantial number of centrists that actually still are interested in doing the right thing. I think they don't get really well empowered until after the 2024 elections. But there's that. But number one, it is up to the voters, and secondly, you got a situation where the members themselves have to have a little humility and figure out what's important beyond slagging each other off every day.
All right, Terry Haines there over at Pangaea Policy here. We'll be back in a moment. This is Bloomberg. A big downdraft in equity markets on the back of a big uptick here that we saw in Treasury yields. Start at the top of the screen here, a 30-year yield that at one point on the day flirted with 5% territory, up 13 to 14 basis points from where it was just yesterday. Similar moves on the 10 and 20-year yields, now approaching a 5% level that the 2-year has been camped out at for quite some time. I want to bring your attention here to the S&P 500, 4229 here. This is now back into a technical territory where a lot of people feared here. A break below that 4,200 level, which we saw earlier today, 4,201. That's the next line of support. That is your 200-day moving average, and we are very close to breaking that right now with not a whole lot of catalyst to keep it from going any further. The VIX ticked back up into the 20 levels, and most of the other major indices right now flirting with significant technical levels of support here that are appearing to quake just a little bit. The Dow Jones Industrial Average today erased all of its gains for the year. Most of the other indices still holding on to their gains, but not necessarily the gravy days that we saw a little bit earlier in the year. That's what transpired here on this Tuesday afternoon, and that is your setup, Scarlett, for what we're going to have when the cash session opens back up on Wednesday.
All right, that is the picture on Wall Street, global Wall Street. Let's take a look at what's happening in Washington and get back to our coverage of the House vote currently in process to oust Speaker Kevin McCarthy. We want to bring in now Bloomberg senior editor Wendy Benjaminson for more out of Washington. Wendy, what's the vote count right now, and is there a magic number here that we're looking for a decision to happen?
Right. Well, the vote's probably about halfway done. It was obviously the vote's going on. I've been away for a couple of minutes, but it was very close at the moment. But the way the numbers are going and the number of Republicans who have already voted to oust McCarthy, it really doesn't look good for him at all right now for the future of his speakership. The magic number we're looking for, because of some absences, are around somewhere between 213 to 216. That when you see that number of yes votes, that will mean Speaker McCarthy is probably out.
Yeah, I mean, unprecedented times here. I mean, we keep talking about 1910. Of course, the last time we had a vote like this, a vote, we should point out that the Speaker actually survived. And last time I checked, I think he had a whole building named after him, Wendy. So maybe there's hope here just yet. But in all seriousness, I do want to get to this idea that we've been here before with Newt Gingrich and John Boehner, who, of course, stepped down before we ever got to this point that we're at right now here. How much is different now, just in terms of the climate, and not just overall on Capitol Hill, but intra-party climate as well?
Right. Well, I think Paul Ryan and John Boehner, and you make an excellent point, Romaine, is they were at the very beginning of this fractious Republican divide between what was then called the Tea Party and the Freedom Caucus, and then Trump came on the scene, Donald Trump, as president, and really sort of threw everything into a mess in terms of Republican unity on the House side. And what you're seeing here is sort of the evolution of that, from John Boehner getting fed up with dealing with the Tea Party members as a moderate Republican to Kevin McCarthy, who is a Trump ally, don't forget, but not ally enough for a guy like Matt Gaetz. And so this is just evolving to a point that I think they will get to a breaking point pretty soon and decide enough is enough.
Can we talk about Matt Gaetz for a second? Because, you know, without getting too deep into it, there's a big question, A, why he's still in the House of Representatives to begin with, but also the bigger question as to why he's able to sort of be the ringleader for this here. Why him?
Well, because he was the one who extracted a concession during the 15 rounds of votes that McCarthy had to endure to become Speaker. He insisted that the only way he was going to vote for Kevin McCarthy was that if any member could be allowed to post a motion to vacate, exactly what we're all seeing happen here today, at any time for any reason. And that was because that was a chit Matt Gaetz wanted to hold in his pocket. And McCarthy, for better or for worse, and it looks like for worse, agreed that any member could post a motion to vacate, and that's what Matt Gaetz did today.
Well, that's how badly he wanted the Speaker position. According to our producer, Tim, the vote right now is 182 in favor of removing the Speaker, 171 against. I'm curious, Wendy, from where you sit, what is the Democrats' endgame in all of this? Because they're sticking together and voting that they want the Speaker gone. But how does that benefit the Democrats in the House?
Well, politically, it benefits the Democrats in the sense that they can say the Republicans are a party that can't govern. They can't even keep their own house in order. So how can you, the voter, expect them to keep your house in order? And that would be the political advantage that the Democrats have now. And, you know, McCarthy kind of blew a chance over the weekend to get some Democratic support when, after there was this lopsided bipartisan votes to keep the government open on Saturday night, then he went out on Sunday and criticized the Democrats. And don't forget, he's allowing the impeachment inquiry into the leader of their party, President Joe Biden. And so they're in no mood to deal right now. So, you know, that's also an advantage they get. And the more chaos there is among the Republicans, the more the Democrats look like the grown-ups in the room, they think.
Well, no one really looks like a grown-up in this room. Wendy, thank you so much for joining us. Wendy Benjaminson, of course, of Bloomberg News in Washington. We want to now bring in Henrietta Treyz. She is Veda Partners Director of Macro Policy Research. Henrietta provides investors with economic policy analysis, leading macroeconomic policy, but also helping us decipher what's happening in Washington. Henrietta, how do you explain this to investors who are probably a little bit cynical of what's been happening there and, you know, are saying as long as there are no dramatic moves, we're okay with the status quo?
Cynical is a great word for it. That's certainly the tone of our clients today. And we just went through the, weeks-long process of keeping the government open, and there was such an overwhelming reversion back to sort of that institutionalist ideal that I certainly adhere to, which is to say the power of the Speaker, the power of the majority leader is so profound that they can use all kinds of procedural hijinks, backroom deals, all the kinds of things that make Congress function in real life, as opposed to just what people use hyperbolically on the floor when they're in front of cameras. There's real functionality that was exhibited in the House over the weekend. And this vote is really just obliterating all of that if it does, in fact, end up to oust Speaker McCarthy. I think there was going to be an opportunity to say the fever had broken. Matt Gaetz has been sidelined. We're going to get a couple of appropriations bills to fund the government beyond November 17th. And then the end shutdown we have to deal with would only be a small scale one. Maybe we even keep economic data coming. But if he loses this vote, all that's going to go out the window. And that was a lot of goodwill that was built up this weekend.
Yeah, I am curious. I'm glad you bring that up here because that was kind of encouraging to see some modicum of compromise. And I know it was probably the absolute least that the folks in Congress could have done here, but something that we haven't seen very often there. And I'm curious as to if McCarthy does indeed lose the speakership as we watch the vote here on the screen, and we get a new Speaker of the House, is that Speaker going to be any more amenable to compromising with the Democrats than what we saw out of McCarthy this weekend?
That's exactly my concern. First of all, let's not jump to the conclusion that we're going to get a speaker anytime soon. This could be weeks long before they land on a candidate. You're going to get outside voices clamoring to come be a part of this. One of the things that I think we need to remind viewers of is that anybody can be Speaker of the House. It does not have to be a sitting congressman. It could be Donald Trump if they want to elect him in. So this can go in a lot of different directions, which is primarily why Hakeem Jeffries was never going to say to his conference, sure, vote for Speaker McCarthy, when obviously they can vote for their own leader, and that would be the appropriate thing to do. So I think first we need to get a speaker, which is definitely going to eat up the rest of this week and probably well into next week, if not weeks beyond. And we could be up against the November 17th deadline for a shutdown again before we have that squared away. And I would just say, past doesn't change here. We still have the exact same number of House members and senators that are from both parties. So it took McCarthy 9 months to break the fever. I hope it doesn't take 9 months for the next guy too.
I am curious. I mean, we talk about this primarily within the context of the GOP, obviously, and their own internal divisions and the idea that this not a good look, to put it bluntly here. But I'm curious as to when this maybe actually starts to rub off on the Democrats and, more importantly, the man in the White House. Because when people look at the government and they see government dysfunction, they don't always cherry pick and say, OK, it was this guy or this guy that's responsible for it. A lot of them just look to the head, the main person in charge, who effectively is Joe Biden, the president. How much blame is he going to have to shoulder for this?
That's a great question. I don't know. I agree with your premise that it will eventually rebound to Biden. I do think it's a question of when, though, not is it going to happen immediately and how bad. We will be fully funded through November 17th. So the reason I don't publish on this the way I do on a shutdown is that there's no immediate economic ramifications to this quagmire. This is a political theater display plainly within the Republican conference. There is no both sidesing this. This is Matt Gaetz and about 10 far-right Republican candidates who are, champions of sort of the Trump wing of the party. And then there's 196 to 200 members of the rest of the Republican Party who are against this sort of circus atmosphere. So there's no both sides equivocating here. This is Republican on Republican fighting. When we shut the government down, if that happens, then Biden gets involved.
Okay, got it. Does this blow back on Matt Gaetz and the guys who are in his corner in any way, Henrietta?
You know, I think you really have to ask Florida that. He's plainly running for governor. He's running for higher office. This is where he throws the rest of his party under the bus. So it'll be up to the RNC to decide how much they want to support him. It'll be up to the next speaker to see how much sway they want to continue to give him, whether they want to change the rules of the Congress and how it's governed. One of the first things that Speaker McCarthy did to placate the far right was put 3 conservatives on the House Rules Committee. We'll see what the next speaker does. Those are really important things to watch.
How does the ousting of a House Speaker, assuming that this does go through right now with the vote the way that it is, how does it change or affect the 2024 presidential race, especially among Republicans?
I don't know that any of these candidates in the House are planning to run. I don't think anybody else is going to jump in the race. So this is really going to be a precursor or a preview even of what the Trump administration would be like if he were elected to the White House. Matt Gaetz and Donald Trump are very close. The people who are voting in favor of ousting Kevin McCarthy are very closely aligned with Donald Trump. So this is a preview of what his administration would look like. And I think what you're going to see is that with gerrymandering in this country, Republicans who adhere to the far right wing of the party are going to continue to elect far right candidates more and more, or almost exclusively, and they'll never change. And then you'll have the moderates that potentially either break the fever on the moderate side or switch to the Democratic Party. But you'll see, and you can track the growth of independent voters in this nation squarely to this kind of antic.
Yeah, and we should point out, Henrietta, just for our viewers, we continue to watch, of course, live footage from the floor of the House of Representatives, relatively unprecedented roll call now taking place, a roll call that has not taken place, at least on this particular procedural measure, since 1910, when they tried to oust the Speaker of the House at that particular time. Kevin McCarthy's speakership now hanging in the balance as we wait for what could be a final vote imminently here, a final tally, I should say, imminently here as to his future. In conversation right now with Henrietta Treyz over at Veda Partners, Director of Macro Policy Research there. And I do want to go back, Henrietta, to the market implications. And I know there's going to be a lot of dominoes that have to fall before it would really have a direct economic impact or a direct impact on the market. But we've been talking a lot about this idea of the recent downgrades or warning of downgrades from some of the ratings companies that seem to be predicated on this idea, not so much as to whether the government is credit worthy specifically, but more about the credibility of how it functions. And if that is called into question, how can you justify a AAA rating?
That's a really fair point. And I'm going to say, as someone who was in there during the 2011 downgrade with S&P at the end of the Budget Control Act, there is a lot of rancor and animosity directed towards credit ratings agencies, as we just saw from a couple of months ago when they had that last downgrade from lawmakers. Now it's going to be really hard to refute the fact that they're calling Congress non-functioning. This is what non-functioning looks like. So when it comes to, I would use a couple of numbers here to put it into perspective. What the far right of the Republican Party and some of the moderates are calling for is a scale of about $16 trillion in deficit reduction. You know, when the credit ratings agencies downgrade us, it's on our debt and deficit. So they want $16 trillion in deficit reduction. We're writing a one-year spending bill that covers $1.7 trillion, a drop in the bucket right there just on this bill. So it's in no way, shape, or form going to eliminate our debt or do anything to remove the overhang of our deficit. What they were about to shut the government down over and what they're about to eject the speaker over is $60 billion. They want $16 trillion in deficit reduction. That's what the credit ratings agencies are looking for. That's what fiscal solvency looks like. And they are doing all of this over $60 billion. It's not functioning. It's not even an appropriate conversation. It's like trying to use a sledgehammer to beat up a fly. It's not an appropriate response, and it indicates dysfunction. So I think that the credit ratings agencies, if they're going to be consistent, have every right to speak to this.
All right, Henrietta, great insights as always. Henrietta Treyz there on fire here with some great insights here about what we're watching on the floor of the House there, Scarlet Fu. I just want to get your thoughts before we go to our next guest here, because when we talk about the idea of what the potential market impact could be, and we know that this vote in and of itself probably won't move the market, but the dominoes that could fall with the November 17th deadline to finally deal with the budget that they didn't actually deal with this weekend, as well as a lot of other issues heading into a consequential presidential election.
Yeah, and all of that, we don't know what's going to happen after that. None of this is predictable. If Moody's is watching this, and I'm sure they are, and they decide to downgrade the U.S., what does that mean for investors who hold on to U.S. Treasury debt and are supposed to only hold AAA debt? I mean, could they overrule that, or do they have to then make a move and perhaps sell some of that debt? What does it mean in terms of our spending on the interest, the cost to service our debt, as opposed to spending on national priorities, like the defense, national defense, like Social Security, like Medicare, all of that. These are all open questions right now. And
let's listen in right now.
Hereby declared vacant.
And there you just heard it here, the man presiding over the House of Representatives right now, saying that the Speaker of the House, Kevin McCarthy, has been ousted. Effectively, the speakership, to use their parlance, has been vacated. That means as of right now, there is no one leading this House of Representatives. The members on that floor right now will have to come up with some sort of solution. Of course, that solution requires a vote that we know, Scarlet Fu, did not necessarily go well when Speaker McCarthy ascended to the speakership early this year. Absolutely. This is historic in nature, and we really talk about just the man that Kevin McCarthy is. You're talking about a man who has basically spent his entire life, his entire career, I should say,
aspiring to become Speaker
on Capitol Hill. Yeah, He worked for a member of Congress for years before running for the state assembly in California, and then actually ascending to Congress. He worked his way up to be a whip, then basically the number 2 guy out there. And then finally, this year, he saw his chance, and he made a lot of compromises to ensure that he was able to get that speakership. And now, just barely, 9-10 months removed from that election to Speaker of the House, he has now been removed.
He's been removed as Speaker. He's still a member of Congress, of course.
Yes,
and the Deputy Speaker, the number 2, would be Steve Scalise. Presumably, he has some role, but as Anne Marie was telling us earlier, there is a list that Kevin McCarthy has drawn up as people who could replace him as a caretaker Speaker before they then move on to find a permanent replacement. And then you go back to that math you were just talking about. How can they elect a Speaker? How are they going to come to some kind of majority agreement?
I mean, that's the big question here. I mean, let's just call it what it is. This is dysfunction, and you go back to some of the credit rating warnings that we had back during the government shutdown fight. The idea that the potential downgrade wasn't necessarily based solely on whether the government could repay its debt, but it was the political process that could disrupt that. And I think we got a picture of that here today.
S&P was ahead of the curve so long ago.
Yeah, we got a preview of that here on October 3rd, 2023. I believe we want to go now to our next guest. John Lieber is joining us right now. He's Eurasia Group's head of research here. And John, appreciate you taking time for us on a historical day here, with the main headline being Kevin McCarthy has now formally been ousted as Speaker of the House of Representatives. And now everyone wants to look forward, John, to who will replace him, whether it's on a permanent basis or on a stopgap basis here. Walk us through here some of the options that we could potentially see here for the House of Representatives.
Well, as you just mentioned, in January of this year, after McCarthy won on the 15th ballot to become Speaker, he had to submit a list to the clerk of the House of people who could replace him were the Speaker's chair to become vacant. That chair is now vacant. The House is expected as soon as tonight to go into that list and choose a Speaker pro tempore, a temporary Speaker who will have the ability to act as the Speaker and dispense of all of his duties. And this situation could go on for quite some time until there's a vote. We don't know who's on that list. We don't know who's going to replace him temporarily. And we definitely don't know who possibly has a majority of 218 votes to be the new Speaker to replace that guy.
Well, John, just I think we are getting a headline right now that at least for right now, Patrick McHenry will be the interim Speaker of the House. We just saw him speaking on the House floor there. The House is now called recess here, but we are learning, Scarlett, that Patrick McHenry, is the interim Speaker of the House until, I guess, they can figure out a more permanent replacement, Scarlett.
Interesting that it's not Steve Scalise, who was the number 2. How does this vote to oust Kevin McCarthy as Speaker of the House, how does it change or alter the power dynamics within the House of Representatives, John?
Certainly gives a lot of power to the most fringe right-wing members who are willing to oust the Speaker. And the unusual thing about this is that this debate is fundamentally about spending, and there's the huge majorities in the House and Senate that are basically aligned around what the fiscal year 24 spending package should look like, and around the fact that the U.S. should be giving more aid to Ukraine. But we now have a group of somewhere between 5 and 30 Republican members in the House who are very opposed to that and are now taking back the power in order to stop that from happening. And that's probably where this ends up. I mean, one of the biggest effects of today's vote is that it becomes a lot harder to finance the government at the levels agreed to in the debt limit deal earlier this year, which increases the probability that you get a continuing resolution, which would, in normal times, mean that there's flat funding going into next year. But because of a provision in the debt limit bill, would likely trigger a 1% across the board cut in appropriated spending if Congress is acting under a CR in January of next year. And that's probably the most meaningful outcome, not to mention the fact that, it's going to be a lot harder to pass additional Ukraine aid, which has massive geopolitical consequences.
Yeah, and then you start to ask questions about what does that mean for the economy and the economy's trajectory and this idea that we have a soft landing. Now that we have an interim Speaker of the House, Patrick McHenry, how long can he stay as interim? How much can he get done before a permanent replacement must be voted upon and named? Could he just be there indefinitely?
In theory, yeah, and this is completely unprecedented. And if you look into the rules under which the temporary speaker has been appointed, it looks like the rules give him pretty broad latitude to act as speaker, at least until there's a new election. So he could be in this seat for quite some time. I'm assuming that in the basement of the House today, the parliamentarians are debating exactly what kind of powers that he has. We this morning were debating whether or not he only has the power to convene the new vote for a new speaker, or if he could pass legislation, put bills on the floor for an indefinite period of time. We don't know. It looks to me like he probably can do this job for a while. It's going to be a long time before they find somebody new to replace McCarthy, because again, you have to get 218 votes, and there is no consensus candidate that likely draws 218 votes. If I had to name one, I think McHenry's probably a pretty good choice, but the conservatives who pushed out McCarthy aren't going to like McHenry any better.
True, but since it was Kevin McCarthy who named Patrick McHenry as the interim speaker, does that mean that McCarthy still has modicum of power, that this would be his proxy in a way?
I doubt it. I mean, there was when Boris Johnson went down as prime minister in the UK, there were talk about, he kind of hung around for a while, and there was some talk about him coming back. But McCarthy just got taken out by 8 of his own members. He's not going to have any power to stage a comeback here, at least in this Congress. And I'd be surprised if he were around at the next Congress. So I'd be very surprised to see McCarthy stage a comeback.
In conversation right now with John Lieber, head of research over at the Eurasia Group. Still standing by with us, I'm pleased to say, is Henrietta Treyz over at Veda Partners, director of macro policy research there. And Henrietta, I think we left you right before we finally got the actual final result as expected. McCarthy ousted, as I'm sure you know. Patrick McHenry now the interim Speaker of the House here. I'm curious just to get your thoughts here on what the functioning of this House of Representatives is going to be in that interim.
What I really want to see, and what I called for before even the speaker's vote was called today, is we need some small groups of members between the House and Senate to get together. And I'm optimistic that that might still come to pass. Most important for your viewers is we need the government to keep functioning beyond the 17th. So what should happen is a group of appropriators from the House and Senate, regardless of what's going on with the speaker's battle inside the Republican conference, should start convening to go through individual appropriations bills. So we'll start with defense and see if we can ping pong back and forth between the House and Senate what that bill might look like. Then we'll move to agriculture. And we'll start to try to cobble together any kind of agreement we can get. And the question about whether McHenry can bring bills to the floor for a vote is a really important one, because even if we reach an agreement at the committee level with members even of leadership, of course, we don't even have one of the big 4 right now, is a really real one. Can we hold the votes on a compromised set of appropriations bills to even satiate what the Matt Gaetz wing of the party wants? They want individual bills considered one by one. And if we don't have those bills or the ability to vote on them, that's going to be your first problem.
And it brings up the whole question, too, I mean, because we always the speaker isn't a monolith. I mean, there's a reason why you have the whips there, I mean, to sort of drum up those votes. And I am curious as to whether there is any sense of loyalty to one person or the other, sort of how that role operates in an environment like this where you're just kind of handed a new person, a new boss, effectively.
Let's go back to some of the previous Republican speakers. When there is a turnover, it is pretty well understood. In the Boehner era, when he was decided to resign, I was there for that one too. Everybody knew that Paul Ryan was waiting in the wings. And I know that y'all have said it so far on this program, but there is no obvious candidate that can get 218 votes. Whether it's Emmer, whether it's Scalise, there are health issues, there are vote count issues. There is not a firm understanding. And, one of the things that the far right has decried is these secret side deals. Well, that's exactly what they're going to try to extract from the next speaker as well. What agreement can you give me on who gets to be part of the conversation around appropriations bills or CRs? So all that infighting, the math doesn't change. That's the bottom line. This is a nightmare of its own making.
Henrietta, really appreciate you taking time for us. Going to have to leave it there. Our thanks also as well to John Lieber over at the Eurasia Group. Here's Scarlet Fu on a very historic day. No matter what your politics are, this is something that just does not happen. And here it did happen.
They have to update all the AP U.S. history textbooks and the AP Law and Government textbooks. You have 216 members of Congress voting to remove Speaker of the House Kevin McCarthy, 210 voting to keep him on. And of course, now he's gone. And it's unprecedented, uncharted territory. We don't know what happens next. Patrick McHenry is the interim speaker. Can he do much more than just hold the vote for the next speaker?
And maybe this would be less alarming if we actually had a longer-term budget agreement already in place, but given that they just kicked the can down the road for 45 days, that complicates things even further. All right, everyone needs to stick around here. Our team on Balance of Power is coming up next. Joe Matthew, Anne-Marie Horton, and the rest here. They're going to have full coverage here of what's going on in the U.S. Congress after the break. This is Bloomberg.